This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This morning, the Bank of England, it studies the experiment known as negative interest rates and calls the experiment, quote, less effective. Chairman Powell, he'll watch the experiment carefully. Governor Bailey, in conversation with Francine Lacroix over Fortnum & Mason Royal Blend Tea. That's coming up. The ADP report, it was flat out not good. Claims this morning, well, they're more important. In Jobs Day on Friday, the president looks for a, quote, big report. And the doctor very in on the pandemic, the message is clear. Dr. Fauci says, listen to the medical experts. Good morning, everyone. Over Fortnum & Mason Royal Blend Tea, Bloomberg surveillance from America, from London as well. Francine, the process of the Bank of England now is different than what we all know. There's no press conference to begin with, right?
No, there's no, and actually, I know for some market participants, it has been quite confusing, Tom. There was no tea involved because actually we were so socially distanced. It was
you were on one side of the river and he was on the other,
right? That there was no cups of tea or anything. That would have been quite quaint. But the way it happens is actually so there's now the release, which is at 7 a.m. London time when the Bank of England, and there's a lot, right? So today they went through rates. They talked about the banks because of the financial stability reports, and they came out also with their new forecasts. And then that basically is the job of the journalists now to transcribe what he says. You're on a call with the governor, and then you put the story out, and then he does a couple of TV interviews. So it's one of the only major central banks that hasn't gone back to doing a press conference like we see with your Jay Powell or Christine Lagarde.
Yeah, interesting. And of course, folks, at 8 a.m. our time, 1 p.m. I believe London time. I get the time zones all messed up. But you're later in the day than we are. The Earth turns that way. We will have Governor Bailey, the really important conversation, and this will come on just before jobless claims in America, so that's well-timed in terms of the shock. I'm going to get to the data in a minute, and I'm going to cut to the chase. The data is a shock. First, though, our first word news in New York City is Ritika Gupta.
Morning, Tom, Francine. Democrats are demanding more Republican concessions for a deal on a stimulus package. Senate Democratic leader Chuck Schumer says there has been some forward momentum, but he's calling on the White House to do more. White House Chief of Staff Mark Meadows says if the two sides can't agree, President Trump may take executive action to extend unemployment benefits and a moratorium on evictions. Twitter and Facebook blocked a video shared by accounts linked to President Trump. Both said the video violated its policies on coronavirus misinformation. In a clip from an interview, the president said that children were virtually immune from the coronavirus. Secretary of State Mike Pompeo is signaling that U.S. efforts to banish Chinese technology will extend beyond TikTok. Pompeo urged American companies to bar Chinese applications from their app stores, he says. Apps like TikTok and WeChat pose significant threats to Americans' personal data. And there are fears of a food shortage in Lebanon. That massive explosion in Beirut destroyed major grain silos, creating a crisis in a country that imports nearly all of its food. And it came at a time when Lebanon is suffering its worst economic crisis in decades. The government is trying to get a bailout from the International Monetary Fund. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities, green on the screen in the equity markets. But right now, there is an unraveling in the bond market, and I want to touch on Turkish lira in crisis now versus the last hour. Here's what you need to know. Yield regime is lower. There's Turkish lira right now unraveling. Let me do Turkish lira first because we went to it, which is a good idea. That is dollar Turkey. What you need to know is Euro Turkey, which of course is a huge European continental trade mechanism, is under crisis now. We're not out to 4 standard deviations, but we're getting there rapidly. This has now gone from plunge to crisis. I'm sure we'll hear much more of this through the morning and particularly the late afternoon in Istanbul as well. In the yield space, yields across the board are lower. The 2-year is barely cracked in the U.S. To 4 digits, and we on Bloomberg Surveillance take our yield out to 4 digits. Thank you, Roman. 0.5264 on the 10-year yield, and the 30-year bond, Francine, moments ago, sharply under 1.20%. That gets my attention. Francine?
Yeah, it gets my attention too. So treasuries are pretty much steady. The dollar index is trading near a 2-year low. European stocks are sliding because we had a couple of disappointing earnings. U.S. futures are pretty much steady. Again, as you say, it's all about the stimulus package in the U.S. It's also about that jobs data out later today. Gold pushing further above $2,000 an ounce. It's a 3rd day in a row. I guess gold will move on what we see with the aid package to counter coronavirus. And then I'm looking at pound rising against the euro after the Bank of England said it did not plan to tighten policy until the inflation outlook was more clear. Tom.
Well, we'll keep close eyes on the data here as we go through. Again, equity markets really not showing it. I should note that the VIX traded to a 22 level here early U.S. Morning. Right now on the stimulus or the non-stimulus in Washington are Emily Wilkins, who knows every marble wall in Congress. Emily, the dynamics are certain, but the quiet thing buried in the articles is the idea that the Senate leader, Mr. McConnell, has stepped away to let this be a White House, Mnuchin, Meadows negotiation with the Democrats, Pelosi and Schumer. I don't buy that for a minute. What is the senator really doing?
Well, if you remember, Senate Leader Mitch McConnell initially did put out a $1 trillion bill, but there wasn't a lot of excitement about it, even from his own party. The White House never endorsed it. And if you remember, the whole White House Democrats dynamic, that has played out before, and that has actually brought a successful stimulus before, with just the White House and the Democrats working on things. I mean, if you saw, the senator decided to have the Senate stay in next week. They were all supposed to go home for August recess, and he said, nope, you guys are staying here in Washington in case we do get something. So he seems to be, at least at this point, supportive of these negotiations.
Well, I mean, the support of the negotiations right now, and I get to these ideas, and clearly on big items they haven't budged. Are there actual compromise negotiations, or is that a fiction?
We are starting to see the sides come a little bit closer together. The White House suggested $400 for supplemental unemployment insurance. Remember, it was $600. That's what Democrats are still pushing for. The two sides have also come a little bit closer together on funding for the U.S. Postal Service. But, Tom, you're right. They're still far apart on a lot of key issues, such as local funding for state and government. Speaker Nancy Pelosi did strike an optimistic note yesterday, saying that she feels there's a light at the end of the tunnel, but there is this sort of self-imposed Friday deadline, and there's still trillions of dollars apart.
So, Emily, what's the likelihood? I know it's difficult to put a percentage on it, but is it likely that we'll get something by the end of the week? And if there's, if they don't follow the self-imposed deadline, is it next week, or does it then kind of unravel?
That is an excellent question. I think the million-dollar question here. I mean, certainly both sides are continuing to work on things. There seems to be at least some sort of progress that we're seeing in the negotiations. But at a certain point, you would think that, President Trump would want to go ahead and at least try to act on this, if only because it's an election year, right? And he wants to be able to show the American people that he's out there working for them and helping them out in this time of crisis.
Okay, what are the priorities that you think, we'll find at the end? Is there some kind of raw sketch that you think we'll end up with? Or is it even, are we too far apart to even figure that out?
I think at this point, if we do see an agreement, we're going to be seeing something to help supplemental employment insurance. You've seen the White House come to the Democrats on that. You've seen discussions about funding for the Postal Service. You've seen both sides sort of be on the same page about funding for virus research, vaccine research at this point. It does remain sort of what else could be in that potential package, but you are seeing at least a little bit of overlap between the sides.
Emily, there's a great mystery, and John Farrow and I have this mystery about the effect of the claims report at 8:30 and also the jobs report tomorrow. Do you buy the idea that actual politicians will actually care about actual economic data?
It depends how big the economic data is. I mean, politicians have the monthly jobs report come out all the time, and those who are Democrats tend to spin it as a negative thing, and those who are Republicans tend to spin it as a positive. Roles that, of course, reverse when a Democrat is in the White House. So we'll see. I think if there's maybe a really big shocker of a number, that might potentially put some more pressure on lawmakers to act, but it also might put more pressure on the president to try and say, hey, I'm going to try and do this solo.
Emily, thank you so much. Emily Wilkins on the pressures in Washington. Right now, the pressures of the market are tangible. I really want to emphasize this, folks. It's yield, 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 yield in the media and, frankly, on global Wall Street. And under crisis, yield becomes a price analysis. One way to look at what the bond market is doing is to understand that bills, notes, and bonds on a price basis are being bid to perfection. And you see that this morning to 4 digits, because that's what we do at Bloomberg Surveillance, 0.5232% in the 10-year. Later today, one of my favorite people out there, the welder from Iowa, Charles Grassley with Mr. Weston. This is Bloomberg. Good morning.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
As the nation prepares to vote during a pandemic, how will mail-in voting shape the 2020 election? I'm Kevin Cirilli. Join us on a Bloomberg special report. Vote from home this weekend on Bloomberg Television.
Bloomberg Surveillance. Good morning, everyone. From Queen Victoria Street, Francine Lacroix. Her conversation with Governor Bailey. Look for that in the U.S. 8 o'clock hour and also at 1 p.m. in London. The markets are on the move. There's no other way to put it. With the yield structure, lower yields, just profoundly lower across the entire curve to 4 digits. The 10-year yield 0.5248%. We're also looking in the FX market at a weaker dollar, but it's fractional. And there are idiosyncratic moves today with Turkish lira truly in crisis. Shahab Jalanus joins from Credit Suisse, and Credit Suisse, of course, has had a many decades view on lira. Shahab, I look at dollar lira and euro lira. Thank you to our team in the control room for putting up both currency pairs. Am I right, Shahab, that dollar lira is a financial pair for Istanbul, and euro lira really speaks to the commercial tensions?
Well, at the end of the day, it's definitely the case that the dollar is the financial currency around the world, and for much of the corporate sector in Turkey, that holds true as well. I think in terms of the euro, clearly one of the important aspects of the Turkish economy is tourism, and right now there's a distinct lack of tourists in Turkey because of the pandemic, and those tourists often come from Europe, and maybe that's where the euro angle comes in, but they come from other places too, like Russia. And so what we're seeing right now is really tremendous weakness in one of the key sources of foreign exchange in Turkey at a time when you still have quite strong credit growth domestically in an attempt to offset growth weakness. And what that's leading to is a perception in the market of a deterioration in current account fundamentals from already stressed levels, and that often ends up in what we're seeing right now, which is tremendous pressure on the currency.
And lovely chart there, folks, going back a long way. Shahab Jalanus, when I look at the path here for the Erdogan administration, the choice set that Mr. Erdogan has, it's about bringing in the IMF, but they're not on good terms. Can they get in early to help out, or do they have to wait till there's a real currency crisis of 4 or 5 standard deviations?
It's a tricky one because, as you say, there's certain political repercussions that come from going to the IMF, and there may be hopes of other sources of foreign exchange through central bank swap lines. For example, there's one with Qatar at the moment that many believe is in play at this point. So it's probably the case still that that's in the future, if it's to come at all, rather than anything that's going to happen imminently. The problem, though, of course, is that Turkey's, while the gross reserves number in Turkey is seen to be reasonably high, the net reserves, when you account for the various sources of reserves that are already accounted for, in essence, many see as negative. So again, these numbers can be a bit opaque. There's a lot of debate about them. But what the market is concerned about is a perceived lack of net reserves in the system here. And that will keep the pressure on the currency until either new sources of funds are found, or Turkey decides to go down a different route, which is to try to compress domestic demand and improve its current account dynamics. And that's obviously a very difficult political choice to make.
Shahab, I know Turkey, and good morning from London, I know Turkey is, of course, idiosyncratic, but is there any read across to some of the other emerging market currencies in the region?
I think the natural tendency is for markets to look at other EMEA currencies with similar balance of payment stresses, maybe not identical, but similar. So the South African rand always comes into the picture at that point within the region. But I think when you think about emerging markets more broadly, one thing that has changed in recent years is that the underlying balance of payments pressures that many faced or tended to face historically are not as bad as they used to be. So in many cases, current account positions have already been tidied up, and that leaves them somewhat less vulnerable. For example, if you go to Latin America, the likes of Mexico and Brazil have definitely done a lot of work on that front, and also have pretty large reserves as well. So there could be a local form of mini contagion around the EMEA region, but it doesn't appear likely to become a global issue. I'd also note that the Chinese renminbi, for example, which tends to set the tone for much of Asia, is actually strengthening right now, and that also helps offset some of the risks of a general problem.
Shahab, I mean, let's go back to maybe your dollar call to kind of like underpin anything. What does dollar, I mean, given, you know, we were expecting the jobs data today and we're expecting, of course, to find out more on the stimulus. What's your best forecast right now?
Well, look, we still believe that in the medium term, the dollar is going down. We think what's driving that is the persistent decline in real interest rates in the U.S., which is coming from very suppressed nominal rates at the same time as inflation expectations are moving up. And part of that is linked to the expectation that the Fed will take in coming months further aggressive actions, whether it's yield curve control or outcome-based forward guidance or average inflation targeting. There's a number of different game-changing themes that are out there that basically the Fed is expected to consider. So that's the reality, and that means that, as we've expected for a while, the dollar will stay under pressure. In the very near term, we can imagine some consolidation ahead of the 120 level, a period of uncertainty, particularly if COVID numbers in Europe keep picking up. Certainly the euro-dollar rate could see a stall for the short term. But once the market gets back into thinking seriously about Fed policy from September onwards, we think the dollar comes under pressure again, and the 120 level in euro-dollar will be breached.
Shahab, I mentioned this with John Gallo, but I'll mention it with you. James Sweeney was on the other day, your wonderful economist, and I'd never heard him more cautious on economics, more cautious on the American economic experiment. Do you have in your head a U.S. 10-year yield where the Fed really begins to act? I mean, it is zero. Is it a tick to the negative, or is it somewhere on this path between 0.5248 and 0? When does the Fed really start to step on the yield curve?
I think in the first instance, any action on yield curve control is likely to be at shorter tenors. For example, in Australia, they target a 3-year area, and that seems more likely in the first instance. You probably would need to see a strong return of pandemic fears, for example, and a major downgrading of U.S. growth expectations on a multi-year basis. Maybe a tremendous rise in unemployment, for example, that becomes persistent before the Fed feels under sufficient pressure to start to target the 10-year sector. I still believe that that's something that's reasonably far away as a risk. But having said that, there's so much uncertainty around what the pandemic could do and how growth will react to that, that of course you can never rule it out. And certainly gold investors, among others, have one eye on that outcome.
Shahab Jalanous, thank you so much. Greatly, greatly appreciated. I'm tearing up, folks, because what you see in front of you is 4 digits. This is what we're doing here, because we talked to Global Wall Street on the 2-year, the 10-year, and the 30-year bond at a 1.1943. On Bloomberg Surveillance, we call these Roman numerals. That's an inside joke, but those are Roman numerals that you see on the screen right now. Francine?
Okay, Tom, we also have some good deviation charts that we'll bring up as well. Now, a little bit later, we hear from the Bank of England Governor Andrew Bailey. That's at 8 a.m. in New York, 1 p.m. in London. We talk negative rates. We talk about the UK and where it is in the cycle. And, of course, we mention Brexit. Up next, we'll have plenty more on pound dynamics. This is Bloomberg.
you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. Toyota posted a surprise operating profit instead of an anticipated loss, and the Japanese automaker kept its outlook for the full year intact. That suggests it sees a recovery after the coronavirus pandemic hammered global car sales. Toyota's revenue in the latest quarter fell 40%. The largest engineering company in Europe dealt with the pandemic better than expected. Siemens' profit rose 8% in the fiscal third quarter. A big jump in earnings at its software business offset declines in other areas. Sales fell a less than expected 5%. And that's your Bloomberg Business Flash. Tom Francine.
Thank you so much, Ritika. Now, I know Tom's all over the Turkish lira hitting a record low as it seems that interventions are failing to stem the drop. I'm also looking at pound. If you look at pound, it's actually moved a little bit on what we heard from the Bank of England. And then you can see gold ever higher, Tom.
Yeah, the data check today, really interesting. And again, yields compressing. There's no other way to put it. The 10-year tips, that inflation statistic, negative 1.09. That is extraordinary. That is a real comment on the state of the American economy. Stay with us, Marilyn Watson with BlackRock. Next, this is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, we were talking about the lira, Turkish lira, definitely one that we have to keep on watching. Still with us is Shahab Jallinous. He is Credit Suisse head of FX and macro trading strategy. Shahab, thank you so much for sticking around. Let me go to pound straight away. So we have the BOE with actually some comments of the forecast, not as bad as they could have been, but there are a lot more downside risks. What does that actually mean in terms of, how should the market interpret this?
I think from the market's perspective, the key development really was that on page 12 of the monetary policy report, there's a section that addresses directly the issue of negative rates. And this matters because over half of the gilt market was trading with negative rates all the way out to 8 years. So there was some expectation, or clearly in the pricing, that at some point in the future negative rates will become a reality in the UK. And this box discussed the issue, but it pointed out some negatives as well that could come from that, such as problems with the banking sector, for example, that might affect the transmission of that. And I think that pushback on any immediate push to negative rates has helped, for example, 2-year bond yields in the UK to actually move higher. And that's actually been somewhat helpful for sterling. So my view is that dimension is probably the more relevant than the actual growth and inflation outlook. On that side, I think the fact that they still maintain that inflation will get back to the 2% target over the next 2 years is also ultimately helpful for sterling. So although some have looked at this outcome as maybe a little bit dovish because of the ongoing focus on downside risks, I think those practical factors, particularly the sense of a lack of commitment to negative rates, has actually been more relevant, has helped the pound.
But Shahab, I mean, there was also some kind of explanation, when they talked about the ECB and that negative rates are more effective in a certain period of the cycle. I mean, do you have an understanding that the Bank of England could go into negative rates post-COVID? So once the trend is on the upside, and what would that do to pound? Well,
that's the thing. There is still obviously the possibility, as the market is pricing in, that what you just described is what pans out down the line. And of course, we still don't know what the economy will do, for example, after the furlough scheme ends in October, the job furlough scheme. That will pose a risk, certainly, to the employment outlook in the UK. And there's still uncertainties, too, about how the trade talks with the EU will pan out, and whether we get a new form of Brexit shock for the UK economy as well. So these risks are still stacking up once we get to October and beyond for the UK economy. So the market won't give up on the idea of negative rates, in my view, and that will still ultimately be something that could hold sterling back. But in the near term, I think simply the fact that the BOE sounded a little bit ambivalent about the issue for now is something that has helped sterling.
Shahab, we've got rate deterioration here as well. I want to link all this together. If we get weak dollar, that implies in some way strong euro. Do you have in your head where strong euro really begins to impinge export dynamics of Europe? I mean, are we there right now at a 118, or is it a 120 or even 125 where it really begins to destabilize the ability to export?
Yes, I think that's a good question. My view at this point is that the exports trend for Europe will be much more dependent on underlying global demand, which is probably linked more than anything to what the form of recovery we get from the pandemic. Much more linked to that than any valuation effects from the currency. So I think you probably need to get to at least 130 in euro dollar before valuation itself becomes an issue. So that's my stance on it, and one of the reasons why we felt comfortable with the idea of the euro-dollar rate moving higher.
Interesting, 130. That's a big difference from what we hear from many other voices. Shahab Jalanus, thank you so much. He is with Credit Suisse. I want to look at the data right now, and it's just simple. Yields come in with a vengeance. We just hit a new low in that TIPS 10-year piece, a negative 1.0942, because we go to 4 digits on our interest rates here. 30-year bond really beginning to look for a 1.18 handle. Lower interest rates before claims at 8:30. With our first word news, here's Ritika Gupta.
Thanks, Tom. Both Democrats and Republicans are looking at the clock as they try to negotiate a new stimulus package. Democrats want more concessions from the White House to meet an end-of-the-week deadline for a deal. White House Chief of Staff Mark Meadows warns that President Trump may take executive action if there's no agreement on extending jobless benefits and a moratorium on evictions. The Trump administration raised a record $165 million in July. That beats the $140 million opponent Joe Biden raised, and it was the first time the president has outraised his Democratic rival since April. Meanwhile, the Trump campaign has spent $82 million on TV ads so far. That's compared with $49 million for Biden. And Goldman Sachs warns that the development of a coronavirus vaccine could upend financial markets. Strategists say that the increased probability of an improved vaccine by the end of November is underpriced by equity markets. Goldman forecasts that the one possibility is a sell-off in bonds and rotation out of technology and into cyclical stocks. And the richest person in the world has turned a bit of his stock into cash. Jeff Bezos sold 1 million shares of Amazon.com for more than $3.1 billion. That's a fraction of the amount Bezos' holdings have increased this year. According to the Bloomberg Billionaires Index, Bezos is worth $189.8 billion. Amazon stock is up 73% in 2020. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom Francine.
Ritika, thank you so much. Now, up next, so we talk more about the UK. We talk about central bank action around the world with David Page, AXA Investment Manager's Head of Macro Research. David is coming up next, and this is Bloomberg.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Bloomberg Surveillance, Tom and Francine from London and New York. Now, Tom, policymakers at the Bank of England have voted unanimously, we know, to keep their key rate and bond buying program unchanged, though they hinted that risks are to the downside and said they stand ready to do more. In a briefing to reporters following the decision, Governor Bailey then said negative rates are part of our toolbox, but at the moment we don't have a plan to use them. Well, we'll hear more from the governor also at the top of the hour when he spoke to Bloomberg TV. Joining us now is David Page. He's AXA Investment Managers, head of macro research. David, what have we learned actually about negative rates? I mean, is there a consensus that actually the Bank of England is still deciding because the future is uncertain, but we're not going to have them now? David?
Yeah, I think so. I mean, I think the bank recognises significant... Hello? I think the bank recognises significant uncertainty about the outlook, and that's one of the issues. So the bank recognises significant uncertainty about the outlook, and that's one of the issues as to whether or not you're going to get easier monetary policy come down the line at all. But I think the market has been led a little bit aggressively towards the outlook for negative rates from the earlier comments that we saw, particularly from Chief Economist Haldane. And we're not convinced that the bank establishment as a whole ever meant to lead the market that aggressively down that road. To our minds, I think there is, a genuine consideration from the Bank of England that they might, at some point in the future, want to use negative interest rates. But I don't think it's anything firmer than that. So I think the market priced the prospect of negative rates too aggressively in the short term, and it's just backing off of that a little bit as it sees a much more neutral assessment from the bank in today's report.
So, David, what does that mean for pound?
Well, I think in the short term, it gives a little bit of support to pound. We're seeing that come through already. I mean, negative rates are still priced. The very short end of the gilt curve is still in the negative territory. So markets are still on balance thinking that the bank might end up using this policy at some point over the next year or so. And as they start to doubt that more, I think you could see a little more upside. Now, of course, the other issue for sterling is the fact that we've got these Brexit negotiations still going on in the background. Much changes in the global economy, but we can still talk about Brexit in the UK. And I think that's going to be a little bit of a negative on sterling, over the next month or so. But as we go towards year end, I think, you have the prospect of the Bank of England not delivering negative rates. You have the prospect of perhaps a deal finally being done, which removes some of the worst case outlook for the UK. And that could be a little bit sterling positive. So we think it's going to be a bit cautious over the next month or so, but I think towards year end, there could be a little bit of a lift coming through for sterling.
Where's the opportunity right now, David? I mean, we're overwhelmed by news, claims, the stimulus here. EM, we've got Turkey blowing up. Fine. Where's the opportunity in all this?
I think the opportunity is one for caution. We've certainly seen markets get significantly ahead of where the data is. We're seeing quite a strong rebound, but in terms of the level of activity, whether we look at the US, whether we look at the UK, it's increasingly obvious it's going to take us quite some time to get back to where we were. We are going to be seeing unemployment numbers coming out much higher towards year end as the various furlough and support schemes roll off. And I don't think markets really recognise that. So I think, we've got a summer where there's hopes and talks of vaccine and whatever else coming through. I think as we come back after the summer and we look at the grim reality of facing a winter, I think there's going to be a little bit more risk caution that starts to come into the market, and that's the way we would expect things to trade.
Well, into claims at 8:30 this morning, what is your unemployment rate for the end of the year for the United States? Many people are at 10 point whatever. Maybe the gloom cruise at 11 point whatever. Where's AXA?
So we were at about 8.5%, 9%. We've just upped that to about 9.5% for the fourth quarter now. And that really is on the fact that, the emergence or the re-emergence of the virus and the softening that we're expecting to see come through over the weekly numbers over the next few weeks. We saw a little bit of that last week. We think it'll carry on for the next couple of weeks. The softness we're expecting in payrolls on Friday relative to the very buoyant June numbers has made us a bit more cautious. So we're looking at a 9.5% rise from there. So 9.5%, obviously still down from the 16 to 20% range that the BLS was talking about for April. So it's a material drop from there, but it's still, well over double what it was at the start of the year. And that weighs, on activity next year. It makes it very difficult for the consumer, not least against the backdrop where, unemployment benefits now have dropped quite sharply, and there's still some uncertainty as to what the stimulus package will deliver to help out those that are still unemployed in great numbers as we go towards year end.
David, overall, what makes you really uncertain about the world economy? I mean, I know it's COVID, but are we going to see lockdowns like we have in the past? And so is it really impossible to look at forecasts, or will they be more targeted?
We're hoping that they're going to be more targeted. I mean, quite clearly the answer is we don't know, and we'll see how they go. But certainly the way most governments are trying to handle this now is to try and enforce more targeted lockdowns. So, particularly if we think of somewhere like Spain, which has very clearly seen quite a pickup come through. It started with rolling out lockdowns in regions, just outside of Barcelona and Galicia. In the UK, we're seeing a similar process come through, and that's obviously what Beijing did a couple of months back when it saw a pickup come through. So I think where possible, governments are going to use data and what track and trace systems they have to try more targeted measures, and that should be much less disruptive to the economies as a whole. But clearly, there's a risk that they just don't have the ability to do that. And there will be an ongoing risk, particularly as we see with Australia as we move into the sort of winter months, that there's people move indoors, the transmission becomes much harder to control indoors than outside, and that could see a pickup come through. And that remains a big uncertainty over our forecast. It's a big downside risk. When the Bank of England talks about skewed downside risks, primarily I think it has that in mind.
Thank you so much, David Page, there, AXA Investment Managers, Head of Macro Research. Now with the Bloomberg Business Flash in New York City, here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom, Nintendo is seeing a gaming boom thanks to people staying home because of the pandemic. Bloomberg's learned that the Japanese electronics company is raising its target for the Switch gaming console to around 25 million units this year. Meanwhile, Nintendo's profit in the latest quarter blew past all estimates. A warning from ExxonMobil. It says that low energy prices may wipe as much as 1/5 of its oil and natural gas reserves off the books. A 20% hit would impact the equivalent of almost 4.5 billion barrels of crude. That's enough to supply every refinery on the U.S. Gulf Coast for 18 months. Commodities trading giant Glencore has scrapped its annual dividend. The firm's net debt surged because it poured money into its trading business to cash in on those volatile price swings. The move paid off. The trading unit earned $2 billion during the latest quarter. That's twice what it did a year earlier. And that's your Bloomberg Business Flash. Tom, Francine.
Ritika, thank you so much. Now, up next, we have a COVID update. Jason Farley, Johns Hopkins Professor of Nursing and Infectious Disease-trained nurse epidemiologist. He's coming up shortly, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. and that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety. The classical history of viruses, particularly respiratory viruses, are such that if they are going to be something that is as capable as this virus is of efficiently spreading from human to human, ultimately, if you really want to put the nail in the coffin of an outbreak, you're going to need a vaccine.
Well, that was Dr. Fauci speaking with our very own David Weston. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us today is Jason Farley. He's Johns Hopkins University Professor of Nursing and infectious disease-trained nurse epidemiologist. Jason, thank you for joining us. When you look at some of the convalescent plasma that we're giving to patients and some of the other treatments, what's working?
Right, good morning. There's emerging data from larger and larger studies that really are showing us that the earlier we give convalescent plasma in the onset of symptoms, the better. It is also showing us that it does improve mortality. It does it like earlier in the disease better and pre-mechanical ventilation better, but it still improves mortality even in those who go into mechanical ventilation. So all good news on all fronts. We just need to use it faster in the disease process.
What's the vaccine pipeline looking like, Jason? How close are we to actually, having something that works and that can also be distributed?
Right. We have currently 7 vaccines that are now in phase 3, meaning safety and efficacy studies. So, but they are all in their infancy. They're not toddlers yet. They're all beginning to enroll across various countries around the world. And so what we know about that is it will depend on the local prevalence in the local region about the sample size. And so we anticipate that they're going to enroll quickly and very quickly, but we are still looking at early next year at the earliest before we probably have the first evidence of which vaccine might be rising to the top in terms of protections.
Professor Farley, there's still so much that we don't know about the vaccine. What are the most pressing things that we need to look at through studies?
Right. So as we roll these out into these phase 3 studies, the total number of doses that lead to produce the vast majority of people to have protective antibodies is really important. We think we know it from smaller studies, but these larger studies will first help us answer those questions. Is it 1? Is it 2? Is it 3? We believe it's 2 right now, and most vaccines are going out as 2 different vaccines. The second is overall safety and side effects. Anytime you go from a small number of like 25 or 50 patients into thousands and thousands, you see different side effect profiles, and we want to make sure we follow those very closely. And then finally, as we always do with all vaccines, we want to follow long term to see if there are any consequences that were unexpected.
How much of the population, do we know how much of the population actually, has had COVID and developed antibodies?
Yeah, so most of the studies, and this is one of the areas that we need greater data on, most of the studies out there on COVID antibody and prior infection have really been convenient samples, meaning you go, you put online, you show up at a store, you ask people who are there to participate. And, some of the things we're doing at Johns Hopkins right now is really trying to look at truly population representative samples, meaning randomly selecting households, bringing them in, trying to get away with all the noise. And so we are still trying to really uncover what the truth is compared to what convenience tells us. And expediency is what convenience gets us. It allows us to find out an answer really quickly, but they can be biased oftentimes. And so what we really need now is a better estimation of what is truth. And we're starting those studies at Johns Hopkins next week.
Jason, when you look at the debate about opening schools and not opening schools, I know in the U.S. it has to be state by state, depending if they're the number of cases are going up or down. But what do we know about how difficult it is to stop transmission amongst kids?
Yeah, I think, the CDC just reported a youth camp in which all camp counselors and the children were required to be tested for coronavirus and be negative 12 days prior, sometime in that period prior to attending the camp. And what they've now seen is, despite the fact that they were tested within 12 days, all tested negative before they arrived, within that 12 days, someone became positive and then subsequently resulted in large transmission in a 7-day camp period for children. And what that really means, and if we translate that into what children are seeing in their school openings, we've already had in some jurisdictions who've opened, children test positive and entire classes, and if not entire schools, have to go on quarantine out of the school. So we're looking at a pretty chaotic period for children who are going back into the classrooms as people make decisions, get tested, potentially need to get retested, and then ultimately making decisions about whether or not to stay in the class or to be quarantined.
Jason, thank you so much. Jason Farley there of Johns Hopkins. And be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversation with Johns Hopkins. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Evidence that the recovery is leveling off.
I don't think it's a W-shaped trajectory. It's not going to be a downturn again.
The global economy is healing, but there's no vigor to that economic recovery.
Markets don't like uncertainty.
You will see some investors begin to take some chips off the table. You're already seeing it in the futures data.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene, claims data 90 minutes away. This equity market just breaking down a little bit.
Claims data today, John, is hugely big, and the market is really out fronted. I mean, we can do a data check here. I'll let you do it, John, but there's just no question. Yields have come in, and I'm going to use the phrase abrupt, John. There's an abrupt lower yield structure this morning.
In the last 10 minutes, Tom, equity futures breaking down 9 on the S&P 500. The long end of the Treasury curve outperforming a flatter curve. Lisa, the data, 8:30 Eastern.
Yeah, we're looking for initial jobless claims as well as continuing claims out of the United States. Interesting to see the deterioration. People are expecting a slight improvement in the absolute numbers, but it's not just the numbers. It's the type of job losses that we're experiencing, more permanent, less temporary. Then after market, we get earnings from Uber and TripAdvisor. I find this interesting, especially given Hilton posting a quarterly loss that came out at 6 a.m. this morning. Interesting to see that particular sector, which is one of the hardest hits of the pandemic. And then also today, President Trump in Ohio speaking about the economy. John, very much interested to hear what he is proposing on infrastructure spending, or looking forward, what can actually stimulate the economy, not just prop it up.
24 hours away from a self-imposed deadline down in Washington, D.C. Much more still to come on that. And your equity market this morning, good morning to you all. Here's the Thursday morning price action. Equities gapping lower in the last 10 minutes. No drama, down 9, off by 1/3 of 1% on the S&P. In the FX market, a weaker euro, stronger dollar, euro dollar 118.42. We're down 0.2%. There's the move in the Treasury market. The long end, 30s, 10s, that's where the outperformance is. Yields down 3 on a 10-year to 0.51%. And in the FX market, this one gets your attention in emerging markets. Dollar try, record high. That is record weakness for the Turkish lira on that currency pair. Tom Keene, 7.26 on our screen right now. An unbelievable move that you, sir, have been on top of the last couple of weeks.
It's idiosyncratic, but it's not politically. There's all sorts of politics in the Levant. Obviously, the tragedy of the Beirut bombing. But, John, this is a big deal for Turkey and, frankly, for all of Europe. You look dollar lira or euro lira. Shahab Jalanu is making very clear dollar lira is the global Wall Street instrument. And I'm looking at the jump in it, the standard deviation move, and we're really not out to the word crisis, but we can say this morning, John Ferro, that the lira plunges.
Let's head straight to the global capital of foreign exchange, shall we, Tom Keene? To London we go and catch up with Kit Jukes of SocGen. Kit, let's just start with the economic data, 90 minutes away in the United States. What are you looking for, Kit?
I'm hoping we don't get another uptick in new claims, and even more so, another uptick in continuing claims, just because this would be an awfully high level of unemployment for things to stabilize with the unemployment rate getting stuck around here. There's an awfully big hole still to fill in, and you've had decent number on ISMs, and on quite a lot of the data has said that yes, there's been some bad news on the virus, but without a return to lockdown, things carry on. And so the labor market data have to have the capacity to really put a dampener on that kind of story.
You know, Kit, I look at this and I loved your morning note, the acuity of it as you look at the granular data around all these political emotions, including the claims report at 8:30. And I got to go to the bond market, Kit, and we go out to 4 digits here on Bloomberg Surveillance. We call these Roman numbers in honor of Roman who made this happen. But going out to 4 digits on the 10-year yield is just simple, 0.5150. What does it say to you, Kit Jukes, and where is the critical 10-year yield?
I guess the critical 10-year yield is when it goes negative and joins the rest of the planet. That's where we just go nuts. But I mean, it's, you know, we are in pretty new territory in terms of this move, and that's what I mean when I say that some of the data has shown, you know, resilience with the sort of the wider spread around the United States of the pandemic. But there's just a continued hunt for safe assets and a continued belief that rates are staying low for just as far as the eye can possibly imagine, and you know, that doesn't look as if it's going away anytime soon. But say, look at TIPS yields. I mean, they are just accelerating away. So today, I think that market is clearly, we're frightened of bad numbers as opposed to braced for strong ones.
What strikes me is the incredible divergence and the widening divergence in developed markets' ability, the U.S.'s ability to lower rates and even issue more debt, and the lack of that ability by a number of developing markets. Turkey is its own idiosyncratic story, but how representative is it of emerging market nations that are not able to ease some of their monetary policies to juice growth for fear of capital flight?
Yeah, we have to be precise about which emerging markets, but there's more than one. I actually think that where we've got to this year, in a sense, the weakest currencies, it goes, you know, we still have a considerable weakness out there for the Turkish lira, the South African rand, than we do for the Brazilian real this year. The Morgan Stanley folks talked about the fragile 5. India and Indonesia further east are in much better shape than the terrible 3 or the fragile 3. If it's G3 developed currencies which are all resilient, it's really those G3 EM ones that are together weak. But if you are dependent on foreign capital, you do not have the ability for QE aggressive fiscal responses to the pandemic, and you live, you know, in danger of what the global environment is. And here we are in August, and you know, August is historically not a good month to need to go to the world and borrow money, and this is what we see.
Kit, you're worried about the month of August, aren't you? Just walk us through that, what you're looking for this month.
Well, so, you know, we put out a bunch of pieces separately at our shop where the rates guys were worried about risk aversion in August, the emerging market guys were worried about risk aversion, and I was looking at various currency trades that do well in August. The currencies that do badly in August do include, you know, the Turkish lira, the Brazilian real, the South African rand. What does well is the dollar and the yen and gold. Historically, I don't know if gold can do well starting from here, but what happens in August is that it's illiquid and volatile. You see a pickup in volatility typically, and therefore uncertain. And what you can see today is that in an illiquid market, these fragile emerging market currencies can gap wider incredibly quickly on really no volume at all. It's just a daft market, and that's what's happening.
I mean, Kit, I think this is brilliant. It's great to go around the world, but the answer is Jerome Powell is central banker to the world. And to go back to where you said, I guess the 10-year yield is important in a negative statistic, 0.5150, folks. We're getting very near the workout of a week ago or so. But Kit, there's a point here where the central bank has to say, okay, the market's finally testing. Is that a 0.40? Is it a 0.20? Or is it really they're going to wait for a negative statistic?
I think they have very little choice, but, you know, the Fed's made it clear they're either adding more money or, you know, they'll wait for inflation to come up. They know that the downside risk of the economy is still there. So, you know, so to me, the Fed is on easy, staying easy. They're there to protect the markets. They came in and delivered, you know, massively accommodative policy globally in March with all the international moves they did on the Treasury repo and on the swap program. Hugely positive in turning around sentiment. That's weakened the dollar, but it's weakened the dollar more against developed market currencies than these fragile ones because it hasn't unlocked global capital, and that's really a problem for growth in those states.
If you're just joining us on Bloomberg Television, Bloomberg Radio Worldwide, surveillance with you this morning, Lisa Abramowitz, John Farrow, and Tom Keene. Markets are on the move before the claims data, which we see here in an hour and 20 minutes. Francine Lacroix's interview with Governor Bailey scheduled at the top of the 8 o'clock hour as well. Kid, okay, the bond market's on the move, but the dollar shows that persistent resilience even within a weak dollar regime. Can SocGen call weak dollar?
Yeah, once this calms down. At the moment, the dollar is still slightly stronger than it was at the start of the year in trade-weighted terms, on the BIS measure of so broad trade-weighted terms. It will weaken, but I don't know if it can weaken until we can stabilize these fragile emerging market economies, because what weakens the dollar is American investors looking for higher yield somewhere else. The Fed's done its job and make sure that there's no yield unavailable at all in the United States. I don't know, the NASDAQ's done its job to get equity prices so high. I'm not sure if many people have the stomach to keep on chasing, but we have to this is where the pandemic hurts. Can we make the rest of the world attractive to sell the dollar into buying, really in a proper way around emerging markets? A bit, without getting a vaccine or some kind of solution for the virus.
That's the key question, Kit. Before we let you go, positive or negative print in payrolls tomorrow?
I hope positive.
The fact that it took a while to answer that question speaks to how uncertain tomorrow is. Kit, great to catch up, sir. Kit Jukes of SocGen. Tom Keene, that's the issue for so many people, the unpredictable nature of a payrolls report 25 hours away.
Yeah. Well, it's an unpredictable nature. It's always unpredictable, John. We got to really make this clear.
Well,
the media
ban,
talks
Tom,
in certitude.
Like 1 million, 2 million wide
the ban, folks, is not here. It's here. On radio, my arms are way, way out. It's a ginormous uncertainty into tomorrow.
Should we get to the negative rate debate as well, Tom? Looking forward to Francine Lacroix's interview with Bank of England Governor Andrew Bailey.
What do you think?
They just seem to want to flirt with negative interest rates and retain the option to do something in the future, Tom. I don't think they're anywhere close to instituting negative interest rates at a Bank of England.
But the market, my point, John, is the market makes you close. The facts make you close.
Yes, and there was a whole sheet in there in the monetary policy report, a whole page, Tom, maybe even two, dedicated to walking us through negative interest rates, the effective lower bound, and what it could mean for the Bank of England. When you put out something like that, that just speaks to the idea that they're nowhere near to doing this. Much more on that still to come on this program. Looking forward to that conversation. We'll bring that to you in around about 15 minutes' time. From New York City this morning, good morning. Here's the price action. Futures, they're negative. We're down 7. We're off by 0.2%. Cross-asset worldwide, we shape up as follows. In the last 10 minutes, the last 20 minutes, futures gapped a little bit lower, and a bid came into the bond market. Yields are lower by 3 basis points to 0.52%, just to round that up for you. In foreign exchange, the euro just a little bit weaker, euro dollar 118.36 after we saw the dollar weakness broad-based in yesterday's session. And as we count you down this Thursday morning to jobless claims in America, from New York City, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. Democrats are demanding more Republican concessions for a deal on a stimulus package. Senate Democratic leader Chuck Schumer says that there has been some forward momentum, but he's calling on the White House to do more. White House Chief of Staff Mark Meadows says if the two sides can't agree, President Trump may take executive action to extend unemployment benefits and a moratorium on evictions. Twitter and Facebook blocked a video shared by accounts linked to President Trump. Both said the video violated its policies on coronavirus misinformation. In a clip from the interview, the president said that children were virtually immune from the coronavirus. And Secretary of State Mike Pompeo is signaling that U.S. efforts to banish Chinese technology will extend beyond TikTok. Pompeo urged American companies to bar Chinese applications from their app stores. He says apps like TikTok and WeChat pose significant threats to Americans' personal data. And there are fears of a food shortage in Lebanon. That massive explosion in Beirut destroyed major grain silos, creating a crisis in a country that imports nearly all of its food. And it comes at a time when Lebanon is suffering its worst economic crisis in decades. The government is trying to get a bailout from the International Monetary Fund. And the richest person in the world has turned a bit of his stock into cash. Jeff Bezos sold $1 million million shares of Amazon.com for more than $3.1 billion. That's a fraction of the amount Bezos' holdings have increased by this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
You see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
If we don't get some kind of deal which offers some additional support to the millions of Americans who are currently unemployed, then the economic bounce back is going to be severely compromised.
And that is why the next fiscal steps down in Washington, D.C. are so important. Paul Donovan there of UBS Wealth Management from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your price action this Thursday morning. Equity futures lower by 6. We're down 0.2%. In the bond market, yields down. We head south by 3 basis points to 0.5166%. Tom Keene working his magic and getting in that 4th decimal point. Well done, Tom. Well done.
It's fun. This is the way the street looks at it.
You're having fun with that.
4 decimal
Can you
points.
explain to our listeners on radio what they're missing out on with your
radio
and
TV? You go to 2 decimal points, and years ago it was a reach to go to 3. but the street, and particularly with the new low-rate regime, constantly quotes 4 decimal points.
There is that, and the fact that Tom Keene has been complaining about this for the last 10 years to the powers that be.
These are Roman numerals.
He gets very, very upset.
Roman got this fixed.
Well done.
It's a good thing.
Congratulations.
Surveillance, we like to go cross-asset and also with detail. Right now, we go to Kevin Cirilli, our chief Washington correspondent. The silence you heard in Washington last night was a president's approved list of debate moderators, and one case Cirilli came up on the list. Kevin, I don't know if you're going to do a debate, but I'm fascinated by the president's demand, and frankly, intelligent demand. Should we kind of like have a debate before the mail-in voting begins? I mean, that makes a lot of sense to me. How should the Democrats respond?
Well, in terms of the early voting and mail-in voting, that's precisely the argument that the president's reelection campaign is making, and they are encouraging any way possible for there to be an additional debate, particularly one in the month of September. Look, the Biden campaign has been hesitant to even engage in this. They have consistently said that they have agreed to the debates, Tom, that they had previously agreed to, and that had already been scheduled. However, I do think that as from a political matter, as the mail-in voting issue becomes more and more important, that there's going to be a broader conversation about an additional debate.
Right. Okay, let's go to the stimulus right now, Kevin. I'm just going to give you an open question. It's Thursday. What happens today?
You know, I was struck by the last 72 hours, Tom, by hearing that they are trending in a more positive direction. I think that you're hearing this from the Democrats' perspective. They feel that they have made some type of concession in terms of saying that they would be reducing the allocations for the U.S. Postal Service. They've said they were willing to back off there. Where they're dug in on is money for the state and local governments. And meanwhile, the president's saying that he would be willing to have $400. That's reduced from the $600, $400 worth of unemployment benefits through mid-December. So he's offering a short-term extension, but an extension that Speaker Pelosi says is not long enough. And she wants to see this go well into the next calendar year. But at the end of the day, when I talk to Republicans, they say that what the president and Secretary Mnuchin are offering to Pelosi is not just from a political matter, but from a practical one. This is really where Republicans are right now. The far flank of the party is saying that they would not be able to get on board with anything more large in terms of money allocation.
Kevin, this is a self-imposed deadline to get this done tomorrow. Arguably, it's already a week too late, so let's ignore their deadline. The deadline's gone. It passed a week ago. What they face is the embarrassment of going home this weekend without a deal. And what we can see is a huge spread between what the White House is offering on state aid, we're reporting $200 billion, and what the Democrats would like, something closer to $1 trillion. How do you close a spread that wide in 24 hours?
You know, and that's really, I think, what's really been frustrating from both sides' perspective. But from a reporting perspective, I think, Jonathan, that really they've really not been very forthcoming either side about specifically where precisely that spread that you just mentioned is going to go. We don't know specifically how from a transparency model, but also from a lack of fraud model, where exactly this funds would go. I mean, you look at what happened in the last round of stimulus, and there were frustration about which companies had access to the capital, which small businesses, was it the well-connected, was it anyone? I mean, you look at that from a transparency perspective, and now you suddenly say, well, here's close to $1 trillion more. There's a lot of questions about it.
Kevin, to the extent that there's any actual deadline, it's that President Trump says that he's going to put an executive order out tomorrow if there isn't a deal reached. How concrete is that? Is he drafting that? What do you hear from your sources?
Yes, he is, and from a policy matter, that extension to $400 through mid-December would be something that would impact a large portion of the Americans who have had to file for unemployment right now during this time. But from a political matter, it also allows him to say that he is a political outsider, was able to bypass Congress and Congress's inaction. But from a Biden campaign perspective, what they would argue is that this is too little, too late. And from an economic matter purely, you know, we got some indications from the White House earlier this week, Lisa, that they were signaling there might be some positive economic indicators coming by the weekend. But coupled with the notion that he would also sign executive orders by week's end, that sets up a day in which the president would be able to say, look at the direction of the economy, and that he's satisfied with a recovery.
Just incredibly frustrating, Tom Keene, to fall into the trap of using the language that politicians are pushing on us over the last week. This word deadline, the deadline for the economy passed a week ago. This is the deadline for them. To go home and say we got a deal or we didn't get a deal.
But, John, we got to go back to civics, 5th grade. Kevin Cirilli, to the point of the executive order, Speaker Pelosi, I believe, from my 6th grade civics class, says the legislature has the power of the purse. How do you do an executive order without the power of the purse?
He's going to be citing in terms of dire need and the need and the urgency in order to extend this. And quite frankly, from a legal perspective, they're also essentially saying they're daring someone to file against them for unemployment benefits. Which Democrat would say, hey, I'm going to take you to court over unemployment benefits right now and in the Supreme Court, and that millions of Americans wouldn't be able to get their unemployment benefits? The thinking would be that they would get to some type of deal by the time it would end up in the judicial system, which even just seems like a long shot. So, you know, from that matter, they're looking at this as this is an economic calamity that needs immediate relief and urgency, a lack of urgency, though, that we've seen in the past week.
Kevin, great to catch up with you, sir. Kevin Cirilli down in Washington, D.C. Tom Keene, there has been some money already appropriated by Congress in the last bill, and what we've got to work out is how much is left.
Yeah.
I think that's what the president is leaning into.
Around. Yes,
they can access that cash and deploy it the way he would like.
Yeah, I mean, you know, on a Thursday, John, and this is, you know, the nostalgia, what you and I have done for years with Bloomberg surveillance, and it's the basic idea that the economic data matters, and we're going to see that at 8:30.
We'll see it in an hour, and we'll see it again tomorrow morning. From New York, good morning to you all. Coming up, Lindsay Piegza, Stifel, chief economist from New York City, claims coming up this morning, payrolls data coming up tomorrow. This is Bloomberg.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and business is depressed.
and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Jobless claims 60 minutes away in the United States of America from New York. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your price action 1 hour away from that data. Equity futures come in just 0.2% in the FX market. Two stories, G10 and EM. G10 over the last month doing nicely against the US dollar, with the exception of emerging market Europe. Everything else, including the lira and the South African rand, not doing as nicely. Dollar lira out to 7.23. We had record weakness on the Turkish lira a little bit earlier on. We back away from those levels in the last hour. In the bond market, this is the setup ahead of the data. 0.52% is your yield. We come down 2 or 3 basis points. All-time lows on a US 10-year earlier this year, back in March. Intraday record low around about 31 basis points. Tom Keene, the record closing low earlier this week, just north of 50 basis points, and we're just off those levels now.
Just off them now. We just had a little relief here in what has been a very difficult hour for the bond market to 4 digits, 0.5199 on the 10-year yield. Right now, and we're going to do this around Francine Lacroix's conversation with Governor Bailey, which you'll see here in a bit. 1 hour from now is, some would say, the statistic of the week. Frances Donald at Manulife made very clear she feels it's the statistic of the week. Lindsay Piegza are with us with Stifel, their chief economist. Lindsay, I want to cut to the chase. There's 3 claim statistics: the weekly number, the 4-week moving average of that same number, and then continuing claims. Which will you look at hardest?
I'm going to look at the headline initial number, because that's really going to give us a sense of the underlying trend or the momentum in the labor market, of course, ahead of the all-important Friday non-farm payroll number. Now, initial jobless claims had been trending down. We had seen that improvement, but last week we did see that uptick. So I'll be looking to see whether or not we do see further improvement, or if we continue to see a reversal of that improving trend. And again, setting that tone for Friday's number, as we are seeing 2 very divergent themes in the labor market at this point. On the one hand, we do know that businesses were in a big rush to reopen and rehire in July. On the other hand, we have the realistic assessment that the number of COVID cases was rapidly rising in the country at the start of the third quarter. So many states that had planned to continue to reopen actually halted those plans or reversed course entirely. So again, we have to see how that plays out into the labor market, and I'll be looking at that headline initial number.
Is the state granularity smoothed out? When we got into this crisis in March on that weekly data, it really varied state to state, who was open, this, that, and the other thing. Is it more rational now, or is there still an irrationality state by state?
No, there's still that irrationality. There's still that volatility. As we saw the number of cases rise, particularly in the southern and western parts of the country, I would expect that to continue to have a disproportionate impact on the claims data in those southern and western states. So we still are not seeing this wholehearted national trend. It is still very segmented across the country, as you would expect, because this is being driven by a health crisis, of course.
Lindsay, I'm so confused ahead of payrolls tomorrow. The ISM came out yesterday looking really strong. The subcomponent, though, when you look at employment, looking really weak still. How do you come up with a number for tomorrow?
Oh, if you look at the consensus, they are all over the board. And you're absolutely right. As I mentioned, the initial claims data ticking back up. The ISM services number looking strong, but leaving that employment component disappointingly weak, well below that 50 break-even part. And then, of course, we had the ADP number, which came in well below consensus at just 167,000. The consensus was 1.2 million. So when we looked at Friday's number, taking that as a whole, what I think it says is the labor market is still improving. We do expect still continued positive job creation in today's number, but at a noticeably reduced pace. So we're looking probably somewhere around 200 to 400,000. And relative to what we've seen over the past couple of months, that will be a disappointing number for the market.
Right. Lisa, did you see how Lindsay didn't answer John's question? She's a pro. That was really good.
I mean, she's trying, honestly, trying to nail someone down on something that's unnailable is very difficult, and she really painted that picture well. There's also a question, Lindsay, of the type of job losses. Are all job losses the same? And as we see the filings remain persistently elevated, we're seeing the composition increasingly toward permanent layoffs rather than temporary ones. There's one statistic in April, 3/4 of all layoffs were considered temporary. That's much, much less now. How concerning is that to you?
That is a big concern. Early on, when we were starting to see this very disappointing components in the labor market, we anticipated a lot of these layoffs, these furloughs to actually come back. But what we're seeing now is that many of these businesses that were able to maybe bridge the gap early on are reassessing now months into this crisis. And they're saying, well, I simply can't reopen my doors, or I can't keep my doors open. And what we're seeing is that many of these early layoffs or even these rehires are now rolling back into new rounds of layoffs. So a second round of layoffs or permanent joblessness. So this really is creating potentially long-term barriers to the recovery for the U.S. economy and, of course, the U.S. labor market.
So I am really cool, and last night I spent a lot of time looking at the way that the number is going to be composed for tomorrow. And well, I mean, I was trying to understand.
No one, not even Lisa, believed it when she said it. Carry on.
I'm just going to put it out there. I spent my time looking at the methodology and exactly which time periods are going to be counted for the employment figure that comes out tomorrow. It's really skewed toward the beginning of the month. So how much does today's unemployment filing really even matter for what we see tomorrow if there is some sort of upside surprise?
Absolutely. And again, a lot of this data is backward looking. So already it's 3 weeks behind. But it does give us a good sense, again, of the momentum of where businesses are in terms of hiring as we look out further to the second half of the year. So, of course, it's not real time. It's not perfect data for today's numbers or for today's economy. But, again, it does give us a better sense of what businesses were thinking, what businesses were feeling early on at the start of the third quarter. And it does paint a picture for what we can expect through the end of the year. And I do suspect, again, that this number will be positive, but disappointing, suggesting that the recovery for the labor market is going to be much longer, much bumpier than many had previously anticipated.
Lindsay, do you think we face the story we faced last time around, that it could take a decade to repair the damage done in just a few months?
I don't know if we necessarily need to say a decade, but it will be several years. The thought that we're going to reopen the economy and it's going to skyrocket from here, we've really put that thesis to bed. It's going to be very bumpy, more of a W-shaped recovery. And getting back to those pre-pandemic levels, it's not a 2021 story or a 2022 story. It's going to be 2023 or beyond. Now, whether or not it goes out to a decade, that remains to be seen. But it's going to be several years before we can talk about pre-pandemic levels for the labor market.
In line with that, Lindsay, you'd have to imagine the Fed's not going to talk about hiking for that long either. How do they formalize that and tie themselves to the labor market, so to speak, which is what Mr. Kaplan of the Dallas Fed has told us on this program in the last week?
Well, I don't know if they necessarily need to formalize that beyond what they have. They've given us pretty clear forward guidance saying they're not even going to think about raising rates until we see vast improvement in the labor market, vast improvement in the broader economy. Now, of course, they could quantify that, but I think we know the general sense of what the Fed is looking for: a reversal of inflation back to 2%, a reversal of growth back to 2%, and we're nowhere near those levels.
What? The data of the next 2 days, the data that we're going to see in 45 minutes, can it make the Fed change tact? I just don't believe that. They've been so patient, so patient. Can it actually adjust their tone?
I don't think one data point should ever adjust the Fed's longer-term strategy. And certainly in this case, I don't think it will either. It will, however, continue to reinforce the Fed's position on the sideline. So if we do see weaker data in the claims data that we're awaiting, or in the Friday non-farm payroll number, again, that reinforces the Fed's position that they will remain on the sideline, keeping these lending and liquidity programs in place, keeping rates near zero levels for the foreseeable future. But again, I don't see any one data point changing that strategy.
One data point that has changed this week and certainly been one highlight has been the negative real yields in the 10-year, hitting yet a new low this morning of negative 1.09%. Do you see this as baking in a viable path toward inflation over the longer term that perhaps is not being fully appreciated in other asset classes, or do you think that this just suggests that the Fed will continue to suppress yields even lower?
Oh, I think the Fed will continue to suppress yields even lower. And they've continued to tell us that inflation, or at least the chairman, has said that inflation is not a concern for the committee at this point. They're looking out to the economy. They're looking out to the global economy. And demand is so depressed at this point with really no improvement in sight that inflation is not one of their concerns. Their concern is getting the economy back on track and helping to bridge the economy during this unprecedented crisis.
Lindsay, great to catch up. Lindsay Piegza there of Stifel. Lisa Abramovich is just so cool. I've never seen someone get so excited over negative real yields in my life.
I could even dance for you again, but I know that you'd really love that.
I think we'll all take a miss. I think actually a lot of people thought that was cool, your little TikTok dance.
Not my son. My son actually
he didn't like
said
that.
no.
He was embarrassed.
He was embarrassed. He gave me a face palm, and then he said, "You did it wrong."
Should I tell you what's really embarrassing? Walking down the street the other day with Tom Keane, and I've got my all-black mask on, and Tom Keane puts on this Tottenham Hotspurs mask, walking down the street with me. Tom, have you got that with you today?
I sleep with it on, John.
You sleep with your mask on?
I sleep with it on.
With your little
mask and bow tie.
Your Spurs-branded mask. Wow.
Mrs. Keane really is.
What does Mrs. Keane think of this?
She's living the dream.
She said, yeah, exactly. Vet Bill's not happy. But,
Vet Bill's upset by it. Shall I get to the estimates for tomorrow? Huge range. Lindsay Piegza was talking about it in the payroll report, Tom. High estimate right now in our survey. We'll continue to update it. 3.2 million. The low, negative 600K.
John, what I think...
That's the range tomorrow.
Yeah, what's so important here is, you know, you make jokes about the mask. You know what? I got used to the mask. And are we going to get used, seriously, are we going to get used to 9% unemployment rate?
I hope not.
That's a really, really interesting question.
I hope nobody gets used to that. But year end, if you look at the forecast from the likes of the Federal Reserve, Tom, that's where they expect us to be, somewhere up against 10% in the low 9s.
Yeah, well, you know, I'm hearing in the 10%, maybe low 9s, but even some numbers around 11. And the answer is, forget about that. Nobody knows. I mean, am I wrong, John, on that?
No, I agree with you.
Nobody knows.
Tom, no one knows anything about anything. Look at the Bank of England today. Do you think they displayed any conviction whatsoever in their forecast this morning?
I thought they were very clear
Absolutely not.
that they're going through an exercise on negative interest rates. And, you know, you look across the Bloomberg folks and we see all sorts of proprietary research, the three of us, that comes in. And people, I think, really noted they're taking a very serious stare at negative interest rates. We're not doing that in America.
We'll hear from the governor himself of the Bank of England, Governor Bailey, at the top of the hour. That interview, a little bit of it, comes 20 minutes from now on Bloomberg TV and on Bloomberg Radio. Equity futures grinding lower, down 6 on the S&P 500, just a little bit lighter, down 0.2%. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Both Democrats and Republicans are looking at the clock as they try to negotiate a new stimulus package. Democrats want more concessions from the White House to meet an end-of-the-week deadline for a deal. White House Chief of Staff Mark Meadows warns that President Trump may take executive action if there's no agreement on extending those jobless benefits and a moratorium on evictions. The Trump campaign raised a record $165 million in July. That beats the $140 million opponent Joe Biden raised, and it was the first time the president has outraised his Democratic rival since April. Meanwhile, the Trump campaign has spent $82 million on TV ads so far. That's compared with $49 million for Biden. And Goldman Sachs warns that the development of a coronavirus vaccine could upend financial markets. Strategists say that the increased probability of an approved vaccine by the end of November is underpriced by equity markets. Goldman Sachs forecasts that one possibility is a sell-off in bonds and a rotation out of technology into cyclical stocks. Bausch Health says it will spin off its eye care business. The transaction will break apart a company that previous management had put together through acquisitions. Bausch Health's eye unit is growing faster than the core pharmaceutical operations. And Uber is set to report a deep plunge in the second quarter revenue today. The ride-hailing service is out with earnings after the closing bell. Windfall gains from its food delivery service are expected to be overshadowed by drastically lower demand for its core business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The volatility in the first two quarters were quite exceptional this year.
Part of it is participating in the better market opportunities that have existed in the second quarter, and we do expect a normalization of that.
The situation out there is still very challenging and very difficult to predict, so we should never be complacent.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
If you're in a world where the soon-to-be largest economy is authoritarian and state capitalist, you don't have a global free market anymore.
on globalization. Ian Bremmer, Eurasia Group President from New York City this morning. Good morning. Alongside Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action. Equity futures down 9 on the S&P. We have a payrolls report coming tomorrow morning. Jobless claims are around about 43 minutes away. In the bond market, yields head south, down 3 basis points to 0.51%. And in foreign exchange, there's the move on the Turkish lira. Dollar lira out to 722, just off all-time highs. That's record weakness for the dollar against the lira, rather, against the dollar. 2.5%. That's the move today alone, Tom.
John Farrell, there's history being made right now. We've got the right guest for it. I'm going to have you bring in Piotr here on the lira, which is really moving. There's that scene, John, in the end of Lawrence of Arabia where Lawrence realizes they're giving away the Saudi experiment. And there's a map of the Sykes-Picot map, and there's a big black swath. I've actually seen the map, John, at the Imperial War Museum. The French got Lebanon. The French got the Levant. And Mr. Macron has landed in Beirut this morning and has been greeted by tumultuous crowds. This, according to Liz Sly, highly reputable at the Washington Post. This is a story ongoing now, John, and it really shows the broad instability of the Levant all the way up to Istanbul.
Tom, the problem that the international community has right now is you can't just throw money at this situation, because for many, this country's on the brink of being a failed state. And they've got to work out the institutions so that if you give them aid, they can deploy it effectively. And I don't know how much faith there is with that at the moment, Tom.
There's a different fragility in Lebanon, but then you also see it with the complexities of Turkey as well.
Turkey not looking good this morning, that's for sure. The Turkish lira very much on the floor. Piotr Matis joins us now, Rabobank Emerging Market Strategist. Piotr, I know it's become a bit of a routine that you and I only usually catch up when something like this happens, and it speaks to the frequency of how often these kinds of things happen in Turkey. What's different about this moment?
I would say that there are, first of all, lots of similarities of what we witnessed in the summer of 2018. The Turkish lira is falling quite precipitously. And the central bank faces the same major dilemma as on previous occasion, whether interest rates should raise quite substantially by a few hundred basis points. The main difference between summer 2018 and right now is that Governor Uysal, who was appointed in the middle of 2019 to slash interest rates aggressively, faces a tremendous challenge of convincing President Erdogan that raising interest rates would be the right thing to do. And my concern is that he will find it so difficult to convince President Erdogan that Turkey may come dangerously close or perhaps beyond the point of no return, and we're going to witness a full-scale currency crisis in Turkey.
Piotr, what does a full-scale currency crisis actually look like in Turkey?
To me, it would we would see dollar lira at around 10 or even higher. We would see Turkish residents running towards the nearest bank to withdraw dollars because suddenly trust in banks may evaporate. And actually, in my note, I emphasize that trust is one of the most important indicators worth watching in coming weeks or even days, because as we know, the central bank currently relies on record high dollar deposits, borrows dollars from commercial banks to replenish falling FX reserves. So if there's a run on a bank in Turkey, important to emphasize no such signals, warning signals yet, but if such scenario were to unfold, then dollar lira would we would see it significantly higher at completely uncharted territory.
On Bloomberg Radio, Bloomberg Television now, watching the markets moving here, talking emerging markets with Piotr Matis of Rabobank. Gold just out to new record highs. Piotr, tell me what a Turkey does where they have two regimes. They have a dollar-based financial system and a lira-based financial system. How do the people of Turkey survive this currency collapse?
The good news is that Turkish households and corporates are relatively well prepared. They hedge against even weaker lira, as reflected in record high dollar deposits at above $200 billion. So they are prepared. That said, there would be tremendous pain, nevertheless, because a weaker lira, even at current levels, is going to have significant inflationary consequences at the time when inflation is at around 12% and is likely to remain in double-digit territory in coming months, which in turn is going to keep real interest rates deeply in negative territory. And this is one of the reasons why Turkish lira is so vulnerable.
Piotr, just zooming out a little bit, Turkey is its own case, but I wonder how representative it is of other emerging markets that have high foreign currency exposure. I'm just thinking about the fact, this statistic really struck me, that the Turkish central bank spent more to support its currency in the first 6 months than all of 2019, and you're seeing their foreign currency reserves decline. How much of a common story is this?
Turkish lira are definitely to a large extent decoupled from other emerging currencies. July for most of them was actually a very, very good month. So there are some great opportunities in EM space. Turkey is a specific story. I think it's a lesson. It's a warning signal to other influential leaders not to interfere in monetary policy. Leave central banks alone and make sure that they do their job properly. And my concern is that at the time when across emerging markets, central banks cut interest rates to record low levels and, more importantly, started using quantitative easing, there's going to be lots of far more political interference in monetary policy. So I hope that politicians in other EM countries will refrain from trying to influence monetary policy, and Turkey is a very good lesson.
Piotr, I have a feeling we'll be talking again soon.
Yes.
Piotr Mattis of Rabobank on a situation in Turkey.
I hope so. Thank you for having me.
I look forward to it, sir. Let's get to the chart at the moment. Equity futures ahead of the opening bell at 1 hour and around about 40 minutes away. We break down in a previous hour, at the top of the previous hour. An hour later, we gap a little bit lower again. S&P futures down 13 on the S&P 500, off by 0.4%. No drama here, Tom, but just starting to build ahead of the opening bell.
Yeah.
It closed yesterday, just 2% away from record highs on the S&P.
I think you absolutely nailed it. There's no drama in the equity dynamic right now like you see in the bond market and some of these selected foreign exchange. I would say there is drama in gold. I don't know what to make of it, John, other than I can't afford gold.
You can't afford gold.
I'm looking for an entry point.
I think you're looking for an entry point on most asset classes.
I can't
Tom.
find the door to Tiffany's. I'm looking for an entry point.
That is a consistent theme on this program and has been for a number of years. Up next on this program, Governor Bailey of the Bank of England. Looking forward to that conversation on Bloomberg.
gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en una 50 personas y en la otra otras 50. En cada casa había 5 habitaciones.
En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas.
Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración.
Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esa enfermedad yo perdí todo, perdí mi trabajo.
Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Evidence that the recovery is leveling off.
I don't think it's a W-shaped trajectory. It's not going to be a downturn again.
The global economy is healing, but there's no vigor to that economic recovery.
Markets don't like uncertainty.
You will see some investors begin to take some chips off the table. You're already seeing it in the futures data.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An extraordinary week and a very important Thursday. In 30 minutes, a claims report on the jobs day tomorrow. Without question, the two combined greatest mysteries of what we've seen since February. John Farrow, we can't emphasize enough the importance of this claims data.
We really hope we see an improvement here, Tom Keene, after things went the other way last week. And then later tomorrow, we'll get the payrolls report, Tom. Unpredictable. That's the word you'll hear again and again and again until 8:30 Eastern tomorrow morning.
Yeah, well, there's no question about it. Lisa Abramowitz, I'm going to go back to your bond work for years. There is a point always where you switch from yield dynamics and analysis to a price study, and it really is beginning to feel to me right now that all the media and the experts and the pundits are beginning to look at price, not yield of bonds.
Tom, I think you actually underscored one of the most important questions in the bond market this week when you asked, is it the real economy that's driving yields so low, or is it the Federal Reserve? And I think that is going to be a key question going forward as we continue to see the recovery stall out. Can yields go even lower, not because of the Fed promising to buy bonds, but because people don't have faith in the U.S. economy?
Futures negative 12, the 10-year yield 0.5183 to 4 digits, looking at some dollar flatness, maybe a little strength, and we've been focused, particularly in our last hour, on the Turkish lira. Right now, John, we are at an awful risk if we don't get to this important conversation from a lead central banker.
Well said, Tom Keene. Central bankers will offer you a forecast, and then they'll offer you the balance of risks. And the risks around the Bank of England's forecast heavily tilted to the downside. Bloomberg's Francine Lacqua, good friend and colleague, catching up with the Bank of England Governor, Andrew Bailey. Take a listen.
The things we've looked at are broadly further QE, further quantitative easing, potential use of negative rates, and forward guidance. Those are the things that we've looked at.
So yield curve control has not been discussed, or is it something
I mean, obviously yield curve control is quite interestingly discussed in central banks, and we do discuss it. It's something that, I mean, we've preferred to look at quantitative easing and forward guidance as tools in that respect. But I would make the point that we will go on looking at the toolbox. You know, nothing is fixed down forever, but it's not in our planning at the moment. I think it is true that I think when you look at the experience of other countries, they appear to have worked more effectively in the recovery phase. Now, I would, however, qualify that a bit by saying I think there's a tricky identification issue at that point as to what extent it's negative rates that are driving, for instance, the recovery of the banking system, the lifting of the release of provisions, and therefore the ability to lend, and to what extent that would have happened anyway, because it's a cyclical point. It's a rather tricky issue in that respect. So the evidence is there, but it's a little bit hard to identify the causes.
But then again, in terms of sequence, it's not something that you would rule out, right? It could happen at that phase.
Oh, definite message we're giving today is, look, they're in the box. I mean, there are other central banks that have said they're not in the box because, again, their financial systems have got different properties and they draw different conclusions, so I can understand that. They're in the box. We're not considering using them at the moment.
The governor of the Bank of England with Francine Lacroix. John, this is an important statement by him. And again, as you mentioned earlier, this focus on negative rates, forget about that. It's the focus on the dynamics of lower yields.
Flirting with the negative interest rates, Tom. They're in the box, but we don't want to use them just yet. He wants to retain that option. I don't think they're anywhere near to deploying negative interest rates at the Bank of England. Just going through the monetary policy report, Tom, it's that on the one hand, on the other hand, repeatedly, there's no conviction, no consensus on this issue, but clearly the governor sees a benefit in continuing to flirt with the concept, even if they don't deploy it.
And to our world audience on radio and on television, this is so important. This discussion is about the commercial banking industry. And John, that's where our next guest right now really fits in. The ramifications of this econobabble over into the real world of banking.
The effective lower bound in the UK, where is it? Marcus Ashworth joins us right now from Bloomberg Opinion. Marcus, let's talk about it. Where is the effective lower bound at the Bank of England?
0.1, where official rates are, and that's where it should stay. The only thing they should ever think about lowering is their term funding scheme, which is their provision for banks to be able to reach into a pot of extra money and use that to lend to the small and medium enterprise scheme. That they could toy with and take negative to give more boost to bank lending. As far as official rates are concerned, they've listened to commercial banks who put out unremittingly pessimistic forecasts in their results season that going negative in interest rates will be disastrous, particularly for the challenger bank sector and the building society, that's savings and loans. They've listened. What Bailey's having is wants his cake and eating it in saying that they're going to keep negative rates as one of the tools. No, they're not. It's been ruled out an all but a disastrous second wave COVID knock-on effect to the economy where maybe they might have to reach for anything. But I think, the UK economy, much like the US, with large current account deficits, do not suit negative rates.
And Marcus, what's so important here with your work and Jonathan Tice's work as well at Bloomberg Intelligence is a stark difference between London and New York versus continental Europe. David Folkers-Landau has been brilliant on this at Deutsche Bank. With our money market funds, with our fluidity of short-term paper, it's a different dynamic, isn't it?
Absolutely, and we have a huge insurance business in the UK, along with a pension fund. This is disastrous to the savings industry in a way which the European banking sector, which has no other option. The ECB had no other. They never bailed out their banking sector. They had to take rates negative because they had nothing else they could do. And equally, they wanted to keep the euro weak as well, which is the real reason behind QE and negative rates. But nonetheless, this is the UK. It needs to move on and focus on the specifics of helping its banking sector and the whole unconventional monetary tools of QE and interest rates have done their bit. It's now looking at much more specific solutions for what is obviously what the commercial bank thinks is a disastrous economic scenario. And weirdly, the Bank of England has got this very upbeat forecast, particularly on unemployment, which doesn't make a whole lot of sense and is running a risk of making itself look rather foolish.
Perhaps some of those more specific prescriptions are in the box where the rest of the tools are in order to be deployed if there is an emergency. But it goes to a question.
You sound like a central banker.
I mean, look, I'm just following it. I mean, honestly,
if a spot comes open at the MPC, you should take it.
I am going to play that clip tonight on repeat. Marcus, though, I do want to know what the trigger is to deploy some of those tools in the box. I'm going to continue with this, John, until you absolutely can't take it.
No one's going to rule in using something out in that sense. He's right that they should play this rope-a-dope with the markets. Look, everyone misunderstands. If you look at the commercial paper, the deposit, the floating rate, forward rate agreement, swap rates, they're all positive in the UK. It's only the gilt market which is down in negative territory, which is therefore pulling some short sterling futures rates down. It's because there's so much QE from the Bank of England. It's done its job. To cut rates further negative, to give it more room to make something, it's like Alice in Wonderland stuff. They've already got what they want to achieve, which is a super flat curve, very low yields, and Bailey wants to keep that so-called potential negative rate there as fooling us all into believing it's a possibility. It isn't. It would ruin the commercial banking sector in the UK.
Do you want to answer that? Is that Governor Bailey?
Yeah, put him on.
I imagine that's Governor Bailey.
Yeah.
What's he saying, Tom?
No, it's not Governor Bailey. Afterthoughts ordering pizza. Continue, John.
Marcus, let's continue the conversation. You mentioned the benefits of flirting with negative interest rates. What are they?
Well, look, simply put, it upturns the whole natural law of money. It collapses net interest margins to such a level whereby, people, savers are killed, deposit rates will fall, and the paradox of thrift, where people, in seeing these lower rates, actually end up saving more and not spending more, which is it's the complete opposite. The only reason why the European Central Bank did it, because they had another option. Likewise, the Bank of Japan. And you look at both of those economies, it's very hard to say any real positive impacts that negative rates have had. They do it only to boost lending. There are better ways of boosting bank lending than taking interest rate negative, particularly in a current account deficit economy, where you run the risk of having no support whatsoever for sterling. Sterling would collapse.
So, Marcus, what is cable doing at 131? Let's just finish there. What is cable doing at 131.53?
Cable sterling is a dinghy bobbing around the Atlantic. It's all about the weak dollar and some extent the surprisingly and welcome strength of the euro, which, the UK value is not relevant here. It's just being pulled around by two bigger forces.
Marcus, great to catch up, sir. Marcus Ashworth there of Bloomberg Opinion on central bank interest rates, and Tom Keane, this FX market as well. This euro story, Tom, and Marcus wrote about this morning. Euro dollar approaching 120. I think we're back down to 118 and around about 118.50. At some point, this becomes a problem for President Lagarde. I don't know if we're there yet, Tom, but at some point it will.
I've heard a wide band, even up to 130, which is a very, very strong euro. No one really framing that right now. There's just a set of mixed opinions on folks. Dollar, weaker, other things stronger. And then what does that do to their more open export economies? It's been a German issue for years, John. Going back decades and decades, back to when the Lebanese pound actually was one of the strongest currencies in the world. But, there's a real dynamic here about what happens with a weak dollar. But can we guarantee that, John? I don't think so.
I don't think so either, Tom. One thing I do know, in 19 minutes' time, the data dump begins in the United States of America. Jobless claims in the U.S., followed by payrolls tomorrow morning. Here's the price action this Thursday morning. Good morning to you all. Equity futures right now down 11 on the S&P 500. We are down 1/3 of 1%. In the FX market, talked about the euro, 118.44. Just a touch softer, lighter, weaker this morning for the single currency. In the bond market, yields come in 3 basis points to 0.5183% on a US 10-year, and record lira weakness in EM. Dollar lira out to 7.24. From New York City, alongside Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Democrats are demanding more Republican concessions for a deal on a stimulus package. Senate Democratic leader Chuck Schumer says that there has been some forward momentum, But he's calling on the White House to do more. White House Chief of Staff Mark Meadows says if the two sides can't agree, President Trump may take executive action to extend those unemployment benefits and a moratorium on evictions. Twitter and Facebook blocked a video shared by accounts linked to President Trump. Both said the video violated its policies on coronavirus misinformation. In a clip from an interview, the president said that children were virtually immune from the coronavirus. Secretary of State Mike Pompeo is signaling that U.S. efforts to banish Chinese technology will extend beyond TikTok. Pompeo urged American companies to bar Chinese applications from their app stores. He says apps like TikTok and WeChat pose significant threats to Americans' personal data. And there are fears of a food shortage in Lebanon. That massive explosion in Beirut destroyed major grain silos, creating a crisis in a country that imports nearly all of its food. And it comes at a time when Lebanon is suffering its worst economic crisis in decades. The government is trying to get a bailout from the International Monetary Fund. Bausch Health says it will spin off its eye care business. The transaction will break apart a company the previous management had put together through acquisitions. Bausch Health's eye unit is growing faster than the core pharmaceutical operations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
What we have to get comfortable with as investors, as savers, as fixed income practitioners is the fact that zero yields are really a secular phenomenon that we are going to have to contend with over the foreseeable future.
Struggling to get comfortable. That was PIMCO's Jerome Schneider on zero yields for the foreseeable future from New York City this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your data 12 minutes away in the United States of America. Equity futures down 10 points on the S&P, off by a third of 1%. In the bond market, a bid. Yields lower, down 3 basis points to 0.52% on a US 10-year. Bit of dollar strength against the weaker euro, 118.42. Tom Keene, the data 12 minutes away.
Ready for that data. There's no question, folks, that we're seeing the bond market linked in tight with what we'll see with this data and then onto the jobs report on Friday. Right now, we want to bring in one of the most prescient people we speak to, Rule 1, because he's not within the 3 zip codes, which is the complete focus of this crazy business. James Paulson, Dr. Paulson is out of Iowa State and is one of the great voices of the Midwest on the nation's finance and economics. We're thrilled that Jim Paulson could join us this morning. Jim, I know John wants to talk claims with Lisa and all the other stock mumbo-jumbo. I want to talk to you about the virus and how all of a sudden, I'm seeing the headlines of it moving into the great Middle West of this nation. What have you observed out of the Luthold territory on the new advent of cases and deaths in the Midwest?
Well, we've actually been pretty good here, Tom. We had a spike earlier, too, and kind of seemed to get it under control. And although cases have come up a little bit here, I think a lot of that's testing, and we haven't had a big increase in deaths. But there's quite a concern. We're pretty good at wearing our mask here and trying to do all we can to keep that at bay. We're a little worried about restarting school and what impact that may have. But, you know, outside of that, I think we're doing pretty well so far.
You know, when a man is in cash and has been for the last decade, maybe 2 or 3, he starts calling the stock market and talk about it stock mumbo-jumbo, Jim.
Got that right.
Jim, you haven't done what Tom has done for the last several decades. You've been fully allocated and bullish.
Mumbo-jumbo is an Iowa State term, I'm pretty sure. That's,
well, let's talk about this equity market. How does this stock market respond if the data goes in the wrong direction at 8:30 Eastern in 10 minutes and again tomorrow morning?
I think badly, John. If it's truly an outlier to the negative side, I think we get, you know, we get a period of I don't know, full-fledged correction, but certainly a pullback. But I think it's got to be, you know, a true outlier, not just somewhat disappointing, but, you know, widely disappointing, because there's so much error in this data, and no one, you know, when we're talking about millions every month or every week, you've got to have a pretty big error to make that stand out. You know, even like the ADP report, which came in way below, and then they revised up the previous months a whop. So I think a big movement either side of forecast could have big impact in the short run. But I think whatever way it goes, you know, there's still, to me, a fair amount of positive momentum going on here with other reports, whether you look at what's going on with manufacturing and service sector ISMs, for example. So although it's going to have a lot of short-term impact potentially in the stock market, I think it could burn itself out against what other data. And with national cases of the virus coming down and deaths peaking out, you could see some of the on-the-ground data, economic data, start to improve again here as we move into August as well.
Let's talk about where some of this money's parked as well, Jim. You've mentioned the $5 trillion of money in money market funds. We caught up with PIMCO's Jerome Schneider. He's talking about the same thing. What will it take to tease some of that money out of something that's giving you nothing right now?
Yeah, I've just been amazed by the wall of worry that we have and the defensive behaviors. I mean, we've got a stock market that's up 50% from its lows in a very short period of time, and you still got people holding almost $5 trillion of money market funds with zero yields. Every month there's a chronic inflow into bonds at 50 basis points on the 10-year and an outflow from stocks. We've got the American Association of Independent Investors, bulls less bears at one of its lowest levels in history. It's pretty amazing, and it is hard to see what's going to change that. But I think one thing that would certainly do that or help it would be a new high in the overall S&P 500.
Wait, so new highs beget new highs, basically. Well,
I think that could change the headlines, yeah.
Well, certainly, Jim, when we talk about the balance of risks, when we talk to central bankers, they say the balance of risks are to the downside. And for the past few months, when we talk to equity investors, the balance of risk has been to the upside, this idea that you could get better than expected data, or if it underperforms, central bankers and fiscal policymakers will come out with a bazooka and blow it all away in order to make way for new highs. Is that equation shifting now based on what you said about how a really big negative surprise would be negative, full stop?
Well, I think it could be if it's bad enough, Lisa, but I think it's short term because I think we've started the new economic recovery, and what probably the biggest thing that gives me optimism is the massive divot that was created by this pandemic in terms of the economy. We had a record-setting collapse in GDP, a record-setting collapse in inventory drawdowns, a record rise in the personal savings rate, a huge drop in the earnings, a record rise in unemployment, and that all is terrible. But what that tells me is that we have so much room in the next few years to improve the economy again. Imagine the operating leverage for a company if we move that unemployment rate from double digits back to 6% unemployment again. That's incredible earnings abilities. And now we're going to do that with virtually no inventories on the books and whittled down to the bare bones. So I guess this is how recoveries start. It's not surprising to me that this bull market so far is moving very closely with the 82 bull market and the 2009 bull market. The other two recessions that created the biggest double-digit unemployment rates in post-war history. In other words, the biggest divots. And those were followed by really nice and prolonged bull markets. I think this one is going to be another one of those.
Hey, Jim, a conversation will continue. Stay well, won't you? Jim Paulson there of Luthold Whedon. Fantastic to catch up. Equity futures right now down 10 points on the S&P 500, off by a third of 1%. Big rally building up in the NASDAQ. 6-day winning streak on the NASDAQ 100. Tom Keene, year to date so far, 2020. NASDAQ up 27%. That's not the story of this economy. The KBW Banks Index down 33%. Year to date.
Thank you so much for mentioning that, John. It's just, I looked at this yesterday, actually, folks. The banking dearth here is just stunning. I don't know what it means about, the usual mumbo-jumbo, John, of net interest margin and the rest of it, but the fact is the banks just aren't participating, and you can see it on the Bloomberg screen.
That's some really good promotional material. You know that. Great promo for this program.
Mumbo-jumbo.
Monday to Friday. 7 to 9 Eastern on Bloomberg TV and radio. Coming up on this program, a serious conversation about the economic data. 5 minutes away, jobless claims in America. Will we see some improvement from last week as we look ahead to payrolls Friday? Looking forward to catching up with the brilliant, the wonderful Neil Dutter of Renaissance Macro. We'll do that next right here on Bloomberg Surveillance.
all the lodge facilities and on all tourist facilities within the Mara, both in and out, they're all closed down. And we get much of our revenue from the park entry fees and other sources like the balloon safaris, balloon tariffs, even from the lodge rents, and all that has gone down. The surrounding community, when they are desperate, then they can do anything to hunt. And we have been getting such kind of cases of bushmeat, especially bushmeat trade. And we have arrested quite a number. So far, we cannot say for commercial poaching, no, it's only for bushmeat trade. And they kill just because they are desperate to get meat.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing. We keep on, so you can keep on.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Equity futures down 0.25%. Claims data 5 seconds away in the United States of America on Bloomberg TV and radio. This is Bloomberg Surveillance with the numbers. Here's Michael McKee.
All right, John, we're just loading up the numbers here from the Department of Labor, waiting for it to actually refresh, but the forecast was for 1,400,000, and we're getting 1,186,000. So a drop in the number of jobless claims during the week that ended August 1st, last week. Continuing claims come in a little bit lower as well. 16,107,000. The forecast was 16,900. That's down from 17,018,000 the week before. Looking at the overall numbers here, let me just scroll down and we can see the pandemic assistant numbers, the aid that goes to the self-employed and to contractors. That has dropped significantly the week of August 1st, 655,707. That's down from 908,000, almost 909,000 the week before. And the total number of people getting benefits, however, which is 2 weeks behind, is up. 31,308,000. That's up from 30,815,000. But again, that's 2 weeks ago. So it does look like as we got to the end of July that we saw some improvement in the labor market. And we'll see if that translates into any good news in the jobs report. The jobs report, of course, the week of July 12th, when we were just starting to shut down again. So it may not be reflected in this payrolls report if things are indeed getting better.
Bounce off the lows on equity futures, now down just 6 points on the S&P, off by 0.2%. Michael McKee, we've got to look at the trend. Got to say this is encouraging. Good news, because last week was a little bit worrying that we were starting to go in the wrong direction. What's your take on things at the moment, the trajectory, the direction of travel?
Well, I'd want to see a couple of weeks, but it is better news that we've moved this way. The reason I'd like to see a couple of weeks is because we know that it takes a while for the states to process applications, and if people were knocked out of claims and then had to get back in, that might take a little while. If they are not refiling for additional claims, that'll show up in the next week or two, and that would be a good trend.
There's some mathematics here, folks, and what's really hard about it is it's a mathematics of not much data, and Michael McKee knows that's not a good thing. You want to have a lot of data before you make an assumption. Mike, I see a trend from early June. There's no question about that. And I see a pretty good beginning elegant chart of a trend to a better American labor economy. Did that trend start with the stimulus? Is that how we took the kink out of this claims report?
Well, if that is indeed the case, it probably did start with the stimulus and the PPP program because that helped bring people back onto payrolls. The question is how many stayed there. And the problem we have with getting enough high-frequency data is you get things like the home-based report, which surveys small businesses, and you get the Census Bureau's numbers that they're doing this special survey during this time period. And we see a lot of job losses, but what they're not telling us is the job gains. And, of course, the labor market is always full of churn. So we don't know what the balance is at this point. And so far in the payrolls reports, it's come out in favor of more jobs returned. I'm not saying created at this point, but returned than we lost.
Mike, one of the big questions is at what point will we reach some sort of stasis where we can understand the permanent nature of some of the layoffs? Are we getting any sense of what the persistent level is going to be for a prolonged period of time, or is it way too early?
It's too early to get a real feel for what that level is going to be, but I can tell you, and we'll talk about this on John's show coming up at the top of the hour, the number of people who are losing their jobs permanently is rising. The number of people on temporary layoff is falling. So the question is, where do they meet, and how many jobs are actually lost because the companies went out of business? And it's too hard to know that right now. Anecdotally, we hear reports that a lot of companies are doing that, and we're seeing a lot of layoff announcements. Challenger today, a lot of layoff announcements, a big change in that, up 576%.
Yeah, I saw that Challenger number. That's great. Michael McKee, thank you so much. Greatly appreciate it. John Farrow, that intraday chart speaks volumes. For those of you on Bloomberg Radio, it's just a nice spike up from the ugliness of the last 2 hours. John?
Bounce off the bottom, fill in the gap, Tom Keene, almost unchanged on the S&P 500. Similar move in the bond market, though not quite for 10-year Treasury yields. Just a little bounce of session lows. Going into the payrolls report tomorrow morning, Tom.
No question about it. Neil Dutta with us right now, Renaissance Macro. He has been a great optimistic voice over the last decade or so. Neil Dutta, this was a relatively optimistic statistic, as I said, we're beginning to set up a set of data points that show some trend towards healing. Is that what you observe?
I do. I mean, if you look at the jobless claims number today, the non-seasonally adjusted claims number, remember the seasonals matter a lot right now, just given the sheer volume of claims that are being processed. But the NSA number, Tom, that actually dipped below 1 million to 984,000.
Yeah.
So that's something to keep an eye on. So that's, I think, a positive development. Look, I mean, I think the virus, this is something that Jay Powell said, the Fed statement has it. The course of the economy reflects the virus to a large degree, and we know the virus spread more rapidly across the country, starting sometime in the middle of June, and it's coming under some control, some signs that it's beginning to ebb a bit now. And so I think the labor market basically hit a big pothole in July, but we also know that activity, there's still a bunch of sectors that are still doing reasonably well, all things considered. I mean, auto sales picked up better than expected. We obviously know, look at any chart tied to the housing market, whether that's home builders or Whirlpool, they're all showing very strong recoveries, and that's mirroring the recovery we're seeing in home sales. And there needs to be an inventory restocking of some kind. So that's going to support manufacturing. So I think activity is doing okay. The labor market kind of hit a pothole in July, but historically and generally, the labor market follows GDP, and so you should expect labor market activity to accelerate in August.
Red and green on the screen, folks. So S&P futures -2, and we see green with the Dow and the NASDAQ 100 as well. Neil Dutta, what is your unemployment rate statistic for tomorrow?
I think you get another slight tick down. I mean, the thing about the unemployment rate, which was something I've been thinking about, is, as we get to the fall, labor force participation may not actually come up as much as it has been, because parents are going to need to juggle work-from-home arrangements and their children's schooling. And so do you see a scenario where the labor force participation rate isn't actually coming up that much, but the upshot of that, it would be that the jobless rate falls a little bit more than expected. That's something I think people need to keep in mind, and whether that maybe leads to a little bit more wage pressure for those that are working. Obviously, it's hard for parents that physically can't get to work to exert downward pressure on the wages of those that are still working. So that's something I think we should be keeping in the back of our mind. Certainly, if you look at something like the Conference Board labor differential, consumers feel relatively buoyant about the jobs market given some of the data that we've seen, and that would point to a unemployment rate that probably goes below 10% by a few months before the end of the year.
Nasdaq futures positive on the session, now up 0.1%. The S&P just about erasing the losses of the morning so far. Neil, you mentioned some of the seasonal effects. Let's talk about that with regards to the payrolls report tomorrow. How should we navigate the numbers tomorrow with that in mind?
Well, sure. I mean, the most obvious is the state and local government piece, right? So obviously the pandemic forced state and local government layoffs much earlier in the year than is normal. Typically, you see a big seasonal drop-off in June and July. You probably got that sooner, which led to disproportionate declines in state and local government payrolls over the month. So if non-seasonally adjusted state and local government employment is flat in July, the seasonal factor will probably add at least 800,000 to it. So this is one reason why you should be a little bit wary of using the ADP to draw a big sweeping conclusion about non-farm payrolls for July, for tomorrow. And that's because the state and local piece of it's going to show a large seasonally adjusted increase in my view.
Neil, you were talking about consumer spending and how that's giving you some optimism, the auto sales in particular, and I'm wondering how much the expiration of enhanced unemployment benefits factors into this. Everyone was talking about how crucial this was for the continuation of it in order for the economy to remain up. Now it has expired, no deal in sight. How important is it that there is a deal, or do you have to change your outlook?
Yeah, I mean, I think it's definitely something that I'm worried about. I think everyone's worried about it. Obviously, you mentioned that no deal is in sight. Obviously, the markets are disagreeing with that. The markets do see some deal in sight. Otherwise, why would they be rallying on the expectation of, apparently these fiscal authorities getting closer to some kind of an agreement? So, I would sort of take issue with the idea that they're moving further apart. I think they're moving closer. But yeah, I mean, obviously people are going to pull back ahead of those benefits expiring, which is one reason you probably have seen some stalling out and things like credit card spending among low-income consumers over the last number of weeks. So, yeah, I mean, I think the U.S. has great fiscal capacity at the moment, so there's really no excuse to not extend them. So I agree, but it's certainly a downside risk. But I do think it'll get resolved to some degree.
Hey, Neil, great to catch up with you, sir. Ahead of tomorrow, Neil Dusser there of Renaissance Macro. Thank you. Tom Keene, to summarize, Neil, the labour market's the lagging indicator here. And the ISM that we had yesterday, the non-manufacturing ISM for the United States of America, the employment component was really, really soft. New orders component, perhaps a little bit more forward-looking, was really, really strong. And I think for the likes of Neil and others, that's an encouraging sign still, even though people think this recovery will slow down, will fade just a little bit.
The equity markets out front of it are certainly the technology markets of America out front of it. It's been really extraordinary to see that. John, you mentioned how many days in a row the NASDAQ has been up. What I would suggest, John, is, yeah, jobs are lagging, except it's an election year, and jobs will be front and center for the politics of the nation. Well, it's real
for people, isn't it? And isn't that the story? It might not be real for markets, it might be lagging for markets, but for people and their personal experience, Tom, it's painful.
Better said than me.
There's the unch on the S&P 500, unchanged on the session right now, going into payrolls Friday. The data improves a little bit. It's encouraging. The president says tomorrow we'll see a big number. I guess we'll see. Here's the cross-asset price action worldwide, beginning with equities and S&P 500 futures, erasing the losses of this morning, now unchanged, dead flat on a session. In the FX market, euro-dollar 118.55. Treasuries were really nicely bid about an hour or so ago. We give some of that up, now down just 2 basis points on a 10-year to 0.529%. And a Turkish lira just can't get a break. Dollar lira to 7.26. Record lira weakness in today's session. From New York City this morning, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Both Democrats and Republicans are looking at the clock as they try to negotiate a new stimulus package. Democrats want more concessions from the White House to meet an end-of-the-week deadline for a deal. White House Chief of Staff Mark Meadows warns that President Trump may take executive action if there's no agreement on extending those jobless benefits and a moratorium on evictions. The Trump campaign raised a record $165 million in July. Now that beats the $140 million opponent Joe Biden raised. It was the first time the president has outraised his Democratic rival since April. Meanwhile, the Trump campaign has spent $82 million on TV ads so far. That's compared with $49 million for Biden. The Bank of England has raised the prospect of cutting interest rates below zero, but only after the coronavirus crisis has passed. Bloomberg spoke with Bank of England Governor Andrew Bailey.
Negative rates are in the toolbox, but we're not planning to use them at the moment. We've preferred to look at quantitative easing and forward guidance as tools in that respect. But I would make the point that we will go on looking at the toolbox. You know, nothing is fixed down forever.
And you can see more of our interview with Governor Bailey on the Bloomberg terminal, Bloomberg.com, and throughout the day on Bloomberg Television. Goldman Sachs warns that the development of a coronavirus vaccine could upend financial markets. Strategists say that the increased probability of an approved vaccine by the end of November is underpriced by equity markets. Goldman forecasts that one possibility is a sell-off in bonds and rotation out of technology into cyclical stocks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
You see coming. Some things you don't. Seamlessly. We keep on, so you can keep on.
The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
As the nation prepares to vote during a pandemic, how will mail-in voting shape the 2020 election? I'm Kevin Cirilli. Join us on a Bloomberg special report. Vote from home, this weekend on Bloomberg Television.
first problem on policy, I think, is not about getting the deal in the next week. I think that's very likely. I think the problem is about where we are a year from now in terms of fiscal policy turning tight.
I'm not saying Tom Keene's got favourites, but if he had a list of his favourite economists, I'm pretty sure Bruce would be on it.
Got that
Bruce
right.
Kassman at JP Morgan. Tom, looking forward to the conversation with Kathy Jones and Charles Schwab. I'll be catching up with her in about 15 minutes on Bloomberg TV.
Wonderfully holistic is Dr. Kasman, and Kathy Jones, for that matter, gets it done as well. Futures flat, green on the screen. It's a fantastic, interesting dynamic and nuance in the markets today. And to give us perspective from BlackRock, head of global fundamental fixed income strategy, Marilyn Watson, with us right now with a wonderful transatlantic view. Marilyn, I look at the bond market, and there's a point where you switch from yield analysis to price analysis. Is all this is about, whether it's full faith and credit or it's the new Google 40-year piece, that there's a buying frenzy for paper?
I think it's really just really reflective of the environment that we're in now. I mean, if you look at the huge amount of demand for yield and for carry, you look at the enormous amounts of stimulus that you're seeing still coming through from the Eurozone, from the US. At the moment, it's just where do investors put their money? And I think particularly now as well, when you move into August, you have typically thinner markets, more volatility. We've seen obviously events in Turkey today and elsewhere. I think investors are really just scrabbling to find where they can find income and yield and where they can put their money. And so, as you say, I mean, you know, looking at price or looking at the yield, I mean, yields are exceptionally low, but they're going to stay low for a long time.
I mean, Lisa, it's great. The Google 40-year piece, you get a 2% coupon. It's up 2% off the 3-day ago offering, which I think is a greater than 1,000% total return per year. I didn't get into that, Lisa. I'm glad you bought the Google paper.
Yeah, I levered it up with my triple leverage cash fund that I have in the closet along with the oil. I am wondering, though, at what point Google is sort of an idiosyncratic story with the idea of it being a pretty strong company that's enjoying a lot of balance sheet advantages, whereas there are a lot of investment grade companies on the cusp, potential fallen angels. In Maryland, I pair that with the idea that yields, average yields on investment grade bonds have plunged to all-time lows in the U.S. of 1.83%. Is this overdone?
Well, so at the moment, I don't think it's necessarily overdone. I think if you look at, say, the huge amount of demand, but you also look at declining issuance, particularly after you saw the huge supply from some emergency issuance in Q1. We're still in a world which is really starved of high-quality yields. You know, and I think, as I say, given the amount of stimulus that we're seeing and support from monetary policy, but also we are expecting something else from the fiscal side, then, and you look at, you know, tech companies, for example, or communications that continue to do very well during the pandemic, then I don't think it's necessarily overdone. I think it's just that, you know, investors are really trying to find where they can put their money. You know, so we are still overweight tech and communications, for example. And despite the rally, I think, you know, investors need to put their money somewhere. Obviously, we will see a lot of dispersion going forward as we do continue to see how the economy evolves and the trajectory there. Obviously, we have payrolls tomorrow. We have the data today. So I think it's just really investors are really trying to find where they can put their money. And, you know, at the moment, you're not getting any value in treasuries. So where do you put it?
Yeah, in full disclosure, I did not buy Google or any single name anything. Just in case
Apple,
anything,
excuse me.
Just in case anyone was wondering. But I am wondering, Marilyn, from your perspective, where do you draw the line? Where is the risk too great to pick up the extra yield? I mean, if you really want extra yield, you can go into Turkey.
Well, yeah, so you have to take a very clear view on your risk-reward profile and your tolerance for volatility. And I think really when you're looking at an overall sort of holistic portfolio, like volatility is something that you really have to take into account. Obviously, in the emerging markets or in Turkey in particular, then you know that's a specific case because of the dollar demand onshore and the huge funding requirements that they have for the capital account. But I think, as I say, also just looking at the markets now in terms of volatility, it's really important, as you say, particularly now when you're looking at the moves we're seeing in the market, when you're looking at the tightness of spreads, but you look at the very quick moves that you can see when there's some sort of trigger, then factoring volatility into your analysis is important, and really understanding liquidity. I mean, I can't stress enough how important it is to to understand the liquidity of any asset that you want to hold.
And to give you perspective there, Ms. Abramowitz is sidling into the 9-year Turkish piece with a 7 5/8 coupon, trading at 98 right now. It's traded ugly the last couple of days, no surprise, off Turkey as well. Lisa, I just think you should hold out for a 9% yield in Turkey.
Thank you.
Marilyn, I look at all of this and it's great, but within an allocation, it used to be equities and bonds, maybe a little cash as well. Are you finding bonds are part of an institution's allocation now, or have they just given it up because of the yield risk?
So they do still remain part of an institutional allocation, definitely. And, you have seen a shift in terms of where investors are putting their money within the fixed income space, but they still remain a very strong part of an institution's investments or a pension fund. And when you look at demographics, whether it's in the US or elsewhere, then there's an ongoing consistent funding requirement for pensions, for retirement, and for other things. And so I think fixed income remains a key part of an institution's portfolio, but the risk rewards are different. And when you look at the prospect for the equity market versus fixed income in the short term, let's say particularly given all of the stimulus, then, when you look at the correlations, and July was an incredibly good month for both equities and credit, then it's just really important to continue to look at the beta between the different asset classes and maybe rebalance your portfolio a little bit.
Marilyn, thank you so much. Marilyn Watson with BlackRock. Lisa, let's do a data check here on the way out. I'm going to notice Turkish lira, which was really in crisis 2 hours ago, and it's gotten a little bit better right now, 7.25 lira per dollar. I guess that gets my attention. What do you see in bonds, Lisa?
Well, we're seeing the yield come back a little bit, rise a little bit from the lows earlier, but not that much. And the 30-year yield really down there at 1.1993% if we're going to do out to 4 digits like you like to do. Yes, that's what we do here. Yes. What I'm struck by is this idea that naturally yields may be this low when it comes to treasuries. And to the extent that the Fed is supporting markets, it's really supporting the riskier assets of markets. It's pushing investors into corporate credit. And I'm struggling to understand, when do fundamentals matter again? Right? And how do you gauge that? I thought it was really interesting how Marilyn was saying she looks at volatility and she looks at risk-adjusted returns. How do you measure volatility when the Fed's sitting on it?
Well, and again, I would go back, Lisa, to the idea we are in a pandemic, and certainly we've seen that over the last number of days, including that important conversation of David Weston's with Dr. Fauci. Tomorrow is Jobs Day. We've been doing this for years. There's no question it's the greatest mystery of any time I've seen, and we have a wonderful lineup of experts to give you perspective. Ellen Zentner from Morgan Stanley, James Glassman of JP Morgan will join us, Julia Coronado, very visible recently in economics, and we finish up with the financial and bond acumen of Jeffrey Rosenberg of BlackRock. Please stay with us through this eventful Thursday. This on radio and television is Bloomberg.
us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell, erasing this morning's losses on the S&P. We begin with a big issue. 24 hours to go with party leadership on Capitol Hill talking up progress, but facing down the embarrassing prospect of returning home this weekend without a deal. The White House said to be offering $400 per week in supplemental unemployment benefits. Democrats still pushing for $600. The administration offering $200 billion in state and local aid, still $800 billion south of what Speaker Pelosi is pushing for. Tomorrow is Friday, and Friday is very much a self-imposed deadline. It can move. The brutal reality is it's already a week overdue. Senate Democratic leader Chuck Schumer stating, while we have started to generate some forward momentum, we need our partners in the White House to go much further on a number of issues. How much further? Well, in the words of White House Chief of Staff Mark Meadows, Democrats and Republicans are still trillions apart. Joining me now is Kevin Cirilli, Bloomberg Chief, Washington correspondent. Kevin, how do we close that gap in 24 hours?
Democrats are saying that they are willing to negotiate, and in fact, they have lowered the allocations that they would like for the U.S. Postal Service. However, Secretary Mnuchin, Jonathan, saying that's not enough, because on the issue of funding for state and local governments across the country, they are still worlds apart by hundreds of billions of dollars. Meanwhile, the president saying to Democrats that he is willing to extend unemployment benefits through mid-December, however, not at a level that Speaker Pelosi would like to see. He says that he's willing to do $400, lower than the $600 at its current levels. But from a practical matter, when Senate Majority Leader Mitch McConnell is saying that 15 to 20 members of the Republican caucus are not likely going to vote for whatever deal is on the table, this is really the best that Republicans can offer at this particular moment to Democrats.
So, Kevin, where's the scope for compromise as you see things at the moment from the people you speak to on any given day down in Washington?
You know, in contrast to previous fiscal fights, to previous government shutdown fights, this has largely been dealt with by top leadership. There's no Gang of Eight, for example, or there's no special commission that is working to get together to some type of broader coalition or broader deal. Instead, it's only a handful and the same cast of characters that we've been covering for the past several weeks. President Trump, Treasury Secretary Mnuchin, Mark Meadows, Minority Leader Schumer, Speaker Pelosi, and, of course, Leader McConnell. Those 6 individuals, really the only individuals who are doing this. And as a result of that, it's led to increased frustration, quite frankly, that I haven't seen in quite some time in covering these fights for several years amongst rank and file members. They're headed home in just a couple of hours. Yeah. They have plans. They've got to go back to their constituents. They're facing an eviction crisis, not just in the cities, in rural America as well. Millions of Americans, look at the job number, or the economic numbers from this morning. Millions of Americans in need for some assistance, some certainty coming from Washington, D.C., and these rank and file members cannot give it to them.
Well, Kevin, I don't care about the politicians. I think we both care about the constituents. Yeah. The deadline, when we use this word, we've talked about this morning, this is their word. The deadline was last week. It's the deadline for them because they have to face the embarrassment of going home without a deal. Is that really likely tomorrow afternoon, tomorrow evening, that they don't get anything done? There is no agreement?
Based upon my reporting, and I would argue that it's a 50-50 shot that there'd be a major breakthrough between today and tomorrow. And here's why. President Trump is continuing to say that he is going to utilize executive action in order to bypass the stalemate in Congress. And as a result of that, should he utilize executive orders, it would signal to Republicans on the Hill that they can continue to fight because he's going to take off some of the heat, so to speak, on some of the more pressing matters, unemployment benefits and evictions. And so as a result of that, the fight could be prolonged. However, I think that Speaker Pelosi and Leader McConnell understand that those rank and file members have to go back from a down ballot race perspective in the midterms, have to go back and be able to talk to their constituents.
Hey, Kevin, great to catch up, as always. Busy couple of days into the weekend for Washington, D.C. From New York this morning, good morning. Equity futures recover. We were down about 0.5% on the S&P 500, now pretty much totally unchanged on the S&P. Kathy Jones and Charles Schwab warning of the costly fallout from prolonged negotiations, writing the following: logic says something should get done, but every day that goes by without a deal risks loss of income for households and state and local governments. The problems compound very quickly and can send the economy into a deeper dive. Kathy joins us now. Kathy, do you think we've already made the policy mistake?
Oh, I think that we definitely have made a policy mistake by letting the deadline pass, as you indicated last week, on the supplemental unemployment. And I think, frankly, the fact that they can't come up with anything for state and local governments at this stage of the game is really distressing, because what we're going to see is more layoffs, firefighters, teachers, you name it, more cuts in state and local budgets. And that's just going to compound the problem, because that's more unemployed people. That's more decline in the economy. So I think we are certainly in the midst of a slow-moving policy mistake.
Kathy, I'm hearing complaints about complacency all over again. Are you hearing the same thing?
Yeah, I think so. I think that there's a sense that there's always sort of more time, that nothing much is going to happen that's really negative. The market is still really riding on the Fed's largesse. As long as the Fed is there, markets are pretty complacent.
Kathy, how do we get a read on the U.S. economy right now? Claims data was better than expected about 35 minutes ago. Good news. Going into payrolls, the range of expectations could not be wider. What are you looking for on a bond desk right now? What are you expecting?
We're looking for an increase of maybe about 1 million. Again, as you indicate, this is just a guessing game these days with these numbers, but we're looking for it to be modestly better. And because 1 million is pretty modest given the decline that we've had, and that would still leave us with 12 to 13 million people who had jobs at the beginning of the year or don't have jobs now. But if it's in positive territory, I don't think bond yields move very much at all. I think the risk is if it's a negative number, a really weak number, then you could start to see 10-year yields slip through that 50 basis point level.
The direction of travel for yields has been lower. We had south again this morning, down by about 2-3 basis points on 10s to 0.52%. Is there anything you see on the horizon, Kathy, that makes you think, leads you to think that this story is going to change, that yields can inflect higher?
What we would need to see is better real growth, or signs that we're getting better real growth. Right now, the ISMs were pretty good, but we need that real GDP growth to change the trajectory of yields. We would need more serious inflation concerns. We've seen inflation expectations come up, but they haven't really gone very far in terms of getting back to or beyond where the Fed wants them to go. And we would probably need to see some better news in the global economy. Again, a little bit of good news out of Europe today, but in general, the global economy is still moving pretty slowly.
Well, Kathy, you mentioned Europe. Over the last month on my screen in G10 right now, the euro stronger by about 4.8%, the pound up by 5.3%. The whole of G10 has rallied against the US dollar over the last month alone. Talk to me about FX dynamics at the moment and what they mean for you and the advice you're giving to clients.
Yeah, we think that the dollar is setting the stage for a longer-term decline. It tends to move in these very long cycles. It looks like it's put in the top, down about 7 or 8% on a trade-weighted basis against the majors since that spike in March. We think there's scope for it to go lower, and in that case, one of the opportunities for somebody who's willing to take some risk might be emerging market bonds. They typically do well when the dollar goes down. There's a lot of dollar-denominated debt. It makes it easier to service. And there's carry. So we're in a market where you have a buyer of last resort in the Fed holding down U.S. Treasury yields. You get some pickup in yield in emerging markets. So again, it's not for the faint of heart, but if you're looking to pick up some carry, we think that that could be an opportunity coming down the
I imagine you're not suggesting Turkey this morning. Kathy, before we let you go, tomorrow, deal or no deal on Capitol Hill?
Oh, gosh. You know, the politics now is so hard. I will say deal.
Kathy, great to catch up with you, as always, and good to see you too. Kathy Jones there of Charles Schwab. Coming up on this program, we're previewing Friday's payrolls report with Diana Amoa, JP Morgan Asset Management Senior Portfolio Manager, and catching up with Diana on what's happening in foreign exchange, the data, and emerging markets, a conversation you don't want to miss in just a moment. In the FX market right now, 20 minutes away from the opening bell, equity futures recovering. We're down about 0.5% on the S&P right now down by not even 1/10. Pretty much unchanged on the session. From New York this morning, good morning. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news.
Okay, I'm placing a new order to sell short euro at 118.48. So order placed to sell short euro and 118.48.
Take with you. Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
There is a very big downside skew. I think there's a lot of hard work to be done to get the economy back to where it was. We've had quite a rapid recovery so far, which I'm not surprised about as restrictions get lifted. The reason that we issued the guidance, in my view, was to say, look, the forecasts can sometimes look beguilingly sort of straightforward. There's an awful lot of risk in there, and it's obviously distributed one way, and we will be therefore ready to lean in, as it were, and support that.
The Bank of England remaining supportive as Governor Andrew Bailey warns of unforeseen risk to the economy. Cleveland Fed President Loretta Mester echoing that message. It's really going to depend on what the economy looks like. I can't tell you today a timing, but I do believe that forward guidance is one of the tools that provided some accommodation during the Great Recession and our recovery out of that. Bloomberg's Michael McKee joins us right now. Good morning to you, Mike. We've talked about the data already this morning. All of this talk ahead of payrolls Friday.
Yeah, you're going to have to figure that the central banks are going to remain accommodative because they really don't know what's going on in the labor market. And the month-to-month data is a little bit behind, even if it's everybody's focus for tomorrow. Let's look at what people are expecting. The Bloomberg consensus is for 1.5 million jobs to have been created, 1.4 million in the private sector. Remember, ADP measures private sector jobs, and they only came up with 167,000. So somebody's going to be way off. Unemployment rate would fall to 10.5%. Hours worked would drop back a tenth, 34.4. That's if the consensus comes true. But the risks, as Andrew Bailey was saying, are skewed to the downside. And here's a reason why. Take a look at what's happened over the last month when we saw COVID come back. You look at the ADP number, the yellow line there, that fell significantly during the month. And we're also looking at jobless claims, not from today, not the number we got today, but back in the middle of the month. And you can see the white line at the bottom, it dropped. And then we had yesterday's ISM services numbers, the employment index dropped. So during the time when we were measuring the jobs report, it didn't look very good for the labor market. So we may get some different news tomorrow than people are expecting, and you shouldn't take today's jobless claims numbers as any suggestion that things are going to get a lot better. And one other chart I wanted to show you here, and that is the number of people who are on temporary layoff has been going down significantly. But look at the white line. That's the number of people who are losing their jobs permanently, and that number is starting to rise. We'll watch that closely tomorrow because it doesn't matter if you get jobless claims and then you go back to work, your job is there. That's what we're hoping happens. But if companies are laying off people permanently or if they are closing, and we've had a lot of anecdotal reports about that, then there's no job to go back to. And at some point, the jobless numbers stop going down.
Mike, what is the leading indicator right here? The claims that we've seen this morning or the ISM that we got yesterday with a massive surge in new orders?
I think the leading indicator would be the ISM if companies need more people to make those new orders, to fill those new orders, because remember, it's a sentiment index from one month to another, and all they're telling us is that there was a big change, new orders coming in, but we don't know the level. The jobless claims numbers, it's kind of funny. 1.6 million people filed for unemployment last week, and we consider that good news.
I know. It's a ridiculous situation to be in. Mike, in your journalism and your career, have you ever seen a band this wide for a payrolls estimate going into tomorrow? It is remarkable.
Yeah, nobody really can put a firm grip on any kind of estimate at this point because there's so many different factors that go into it. And as you and I were talking about in the last hour, you get a lot of anecdotal information like the home base report and the Census Bureau's numbers, 6.7 million people fewer on payrolls in the middle of July than there were in June, but we don't know how many people got their jobs back, and that's going to be the key.
The estimate tomorrow, 1.5 million. The band, wide, wide, wide. Michael McKee there. Your high estimate, 3.2 million. Your low, negative 600K. Ahead of the payrolls report tomorrow. Those numbers will move around. I'll continue to update you through the day on Bloomberg TV and radio. JP Morgan's Diana Amoa weighing in ahead of that jobs report, saying, quote, risks ahead of the payroll data are skewed to the downside. Within the US, we continue to buy the markets that are supported by the central bank safety nets. The COVID-19 shock has caused a significant change in the monetary and fiscal landscape, which should be supportive of both the euro and specific EM-related currency appreciation against the dollar. Diana joins us now. Diana, we can talk about FX, EM in just a moment. Let's just talk about JP Morgan and your view together with Bob Michael. You're not in the V-shaped happy talk crew. You're talking about 10